And the accumulator model, which is for people just starting out investing, is just a basket of some very basic, S&P index, NASDAQ, small cap, mid cap, international. That one's up 6.5% in 15 days. That should not be happening, right? All these asset classes should not be running together at the same time. You should have some divergences, but that's just how much speculative activity you've got going on in the markets right now.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back at the end of the week for another weekly market recap featuring my very good friend, the gobsmacked portfolio manager, Lance Roberts. Lance, how you doing?
Why gobsmacked? That's a good one.
Because there is so many things going on that I can't wrap my brain around, Lance. I got a ton of them here. This is going to be a real interesting list to get through if we can get through the whole thing this week.
We'll go fast. I'll keep my answers short.
Okay, well, good luck. First, just a nod, we are recording this on 9/11, an event that gobsmacked the country and the world. I think that we still are recovering from. It was one of those events in history that literally just changed the course of history. I got a lot of friends who, were firsthand witnesses to it. I'm sure you probably do too, Lance. I'm sure
I lost friends in that.
Yep.
Yeah.
And I'm sure enough the financial community watching here that we have a lot of folks that have done the same as well. So anyways, just taking a moment to remember what went on then and the
Do you remember what you were doing at the moment the plane hit the tower?
I hate to say this, I was actually asleep. I woke up because I was
That would make sense.
on the West Coast. Yeah, so
Yeah,
I
yeah.
woke up and we were just about to become parents for the first time, and my wife had gotten up and had just left, and we were staying at her parents. And I woke up and I was kind of groggy, and my mother-in-law was just walking around saying, "They're gone. They're gone." And I didn't know what she was talking about. And then she finally came out, "Oh, they're the buildings are what buildings, right?" And then of course got to see the aftermath of this and went into work. I was working for Yahoo Finance at the time, and we had a group of people that were on a plane going to Manhattan for meetings that day that got turned around. Unfortunately, they were safe, but they were going to meet with Cantor Fitzgerald, which was one of the floors that was taken out by the plane. Yeah.
Which is actually, I had two friends that worked for Cantor at the time that didn't make it out of the building.
Yeah.
So,
So,
but it's interesting, there's these events in history that happen where you can remember exactly what was going on. We were in a high-rise building here in Houston, and we were on the 11th floor of this firm I was working for at the time. And one of my coworkers had this little television in his office, and this was back in the day they had rabbit ears and stuff. So just
yeah.
to let you know how long it's been. There's a little 9-inch black and white television, and I walked into his office because the market had just opened, right? Things are just getting off the ground in the morning, and I walk in his office, and there's all of a sudden the news shifts over, and there's this building, kind of with smoke coming out of it, and I'm looking at my coworker and going, how does a plane hit a building? They have GPS and navigation and all this stuff. How does a plane fly into a building? And how can that possibly even happen? And to your point, kind of gobsmacked at just how this could occur. And then right then was the second plane building, and then it was kind of all sunk in that what was going on. And but yeah, I mean, there's a few things in life you can remember very vividly, that occur, and 9/11 was definitely one of those.
One of them. Yeah. My business school roommate had moved to New York at that time and for some reason was home, but his office had a view of the World Trade Center, or his home had a view of the World Trade Center. And like you, Lance, I just remember him telling me like he couldn't believe his eyes, when he saw the first plane. But again, there you're still thinking accident. And then he saw the second plane on its way. And again, the brain just rebelling, like, wait a minute, this just can't be happening this way, right? So anyway, sadly, there were a few things like that we may talk about today. So, but anyways, our deepest memories and condolences for those who lost loved ones on 9/11.
Sure.
All right, so that's a very sad anniversary. Just real quick, want to get out a happy anniversary. My wife and I celebrated our 25th anniversary last night. It was a great time. We went to a really nice dinner at a kind of a high-end farmhouse, and it was kind of fun. We had a great time, but it was funny that as walking in, this gentleman was just sort of staring at us, and we were kind of wondering, "Is something on my shirt or whatever?" And he goes, "Hey, are you Adam Taggart?" So it was so funny that we got recognized from this program
Yeah.
on our anniversary. And Joe from Chicago, if you're watching, it was a pleasure to meet you and your wife last night. And my wife actually, she hit a home run. She got me an absolute great anniversary gift from me. Um, which, do you know what a TheraGun is, Lance?
I don't.
It's basically like a jackhammer with a rubber knob on it. This is actually what it looks like. And it's for basically pounding out like your aches and pains.
Yeah.
It's they call it a percussive massager, but it's really like for sports injuries or sports recovery. So it gets in there and it like breaks up scar tissue and you know, gets tight ligaments to loosen up and things like that. So I put this thing on last night, and it was kind of like a pleasant back alley beating, if you can imagine
Yeah.
that. But my body, which is, you know, it's very stiff just by its nature. But of course, I've been leaning into this sort of strength training program and stuff like that. So I've got a lot of aches and pains and tight muscles and stuff like that. And this thing was just the best ever. So if you're an athlete and you've ever been dreaming about having something like that, I can tell you it is even better than I hoped it would be.
That's awesome.
Yeah, you should try it sometime, my friend. All right. Well, look, Lance. Uh, so on the theme of gobsmacked,
Mhm.
we've seen some more indicators over the past week that you're kind of like some of the price action we saw during the dot-com bubble.
Mhm.
So there was a business called, I think, QMMM. This is 2 days ago. They
Yeah.
announced that they were going to basically start like a crypto treasury, right? That they were going to get some Ethereum and Solana, maybe a little Bitcoin, whatever, and you know that's kind of the thing to do, right? And this small little stock went up by like I think 2,000% at one point during the day, right?
Wow.
So just, I mean, and of course they're not creating any new value. They're just saying, oh, we're going to, you know, put some of these assets in our treasury. But it just sort of like back in the old days when you put .com at the end of your brand, you know, this thing shot the moon. It's come down a lot since then. But again, you know, this is that kind of bubblicious activity. But then Lance, Oracle, right?
Yeah.
You had a $650 billion company shoot up by another 40%
Yeah.
because of guidance it gave. And, you know, they're always giving you their rosiest hopes in those earnings calls with their forward guidance. And the stock had jumped, I think, like 30+% in the a few minutes after the guidance was released. So meaning
Yeah.
totally unvetted by the analyst community. That just seems, I mean, again, I was gobsmacked when I saw that. So I'm curious, what are you thinking?
Well, first of all, I didn't mind it because in the new Simplevisor portfolios that we just launched, we owned Oracle in two of them, our AI model and our crypto model. So, yeah, so it was great. I actually went in right after the open yesterday and trimmed them back to weight and took some profits in it. But you know, the reason that the market really liked that news is because when Nvidia reported their news, they put these projections out for data center builds, and everybody was like, "Oh, nobody's going to build that many data centers," and blah blah blah. And there's a lot of questions around that. And of course, the commentary over the last kind of couple of weeks now has been, "Oh, the AI trade's dead," blah blah blah. Well, what Oracle's announcement did was basically confirm what Nvidia already told us. And so now you've got two major companies confirming the capex build out of AI that's coming, and that just really kind of reset the table on revenue expectations. So that's why you saw that big jump yesterday.
Okay. And I could see that resetting revenue expectations on Nvidia.
Mhm.
Um, hey, okay, all this capex is going to get spent. Who's going to benefit from that? But you know,
Well, Oracle's on the infrastructure side. It's great to have chips, but I got to have the infrastructure. And this is when you're thinking about AI, this is why we own pipeline companies as well. You got to have energy, you got to have power, right? And so they can't get power off the grid, so they've got to go behind the meter and attach the data center to a natural gas pipeline. So that's why we own
mhm.
pipelines. It's great to have chips, but you got to have all the connectivity, the software programming, et cetera, to make AI work. So Oracle plays in that space. Arista Networks, Broadcom. there's a lot of other companies that when you think down the chain of what you need to make AI actually function, there's a lot of companies that will benefit from that.
So do we see a similar reaction amongst a lot of those other names as well? Are they
Yeah, you
up
did.
30 something percent in the past couple of
Not, well,
days?
not 30%, but Oracle's kind of been a laggard to the group. It's kind of been sitting over there on the sidelines, but I mean, it's done well, but it hasn't been an Nvidia, right? So a lot of that was just is like, okay, there's the new, and look, yesterday's move was very exaggerated. So again, that's going to work itself off. It's going to return back to some level. It's extremely overbought right now. So again, that's why I took profits in it yesterday because there was no way it was going to sustain that move. Um, and again, it's down like 4% today. So it's just kind of giving back up some of that excitement. But, you've seen a lot of, look, Arista Networks is up, 60, 70, 80% from April lows. Broadcom's just had an awesome run here over the last, few weeks in particular. And again, a lot of this is the speculative nature of the market. Every asset class is going gangbusters right now, which is unusual, but it shows you just how bullish the market is. There's so much money chasing. I mean, bonds are doing great. Gold's doing great. Gold miners are doing great. Those are defensive names. Those shouldn't be doing as well when the market's doing well, but stocks are doing great. Small cap, mid cap is doing great. There's basically, if you can throw your money somewhere in the market, it's doing very well. I was just talking about this morning as a good example about this. Let me share my, can you give me the screen real quick?
You got it.
Yeah. So I was just talking about this morning. We're doing our real investment show this morning. I was showing these new portfolios that we've launched on Simplevisor, and so if you so these thematic portfolios were all launched on August the 1st. This is September the 11th. This is a month and a half. And the AI portfolio is up almost 7%. The all weather portfolio, which owns gold, gold miners, silver, platinum, some very conservative stocks and owns some fixed income. It's based on the permanent portfolio model. So it's a more conservative portfolio allocation. It's up,
It's almost kind of the anti-AI
yeah,
portfolio.
yeah, exactly. And it's up for, this is the Adam Taggart bunker portfolio. So if you listen to Adam Taggart, this is the portfolio you want. It's
It's
up it's almost up 5% here,
get
right?
out of here.
A pure growth portfolio is up 5 3/4, and small cap mid cap's up 10. In a month and a half, it's up 10%. And the accumulator model, which is for people just starting out investing, it's just a basket of some very basic, S&P index, NASDAQ, small cap, mid cap, international. That one's up 6.5% in 15 days. That should not be happening, right? All these asset classes should not be running together at the same time. You should have some divergences, but that's just how much speculative activity you've got going on in the markets right now. And again, that's not a bad thing, but it just goes to kind of show you where the markets are trading right now.
All right, let's dig into that last point. That's not a bad thing. Um, I don't know. Let me just ask you this, though. I mean,
Yeah.
as Darius Dale, colorfully says, the party gets at its ragingest right before the cops arrive, right? Is this the sign of a party getting out of control, where just everything gets bought? And yeah, it's super fun in the moment when you're in it, but are there consequences to be paid for this, or is there a good
Well,
argument to
sure.
be made that, hey, this is the time to be strong and long?
Well, you should be strong and long right now, for sure. And will there be a payback for this at some point? Sure. Markets are getting very overbought. They're very extended. You're going to have a 3 to 5% correction at some point, but again, that could be this month. It could be November. You typically get a correction in the first week of December because you have all the mutual funds distribute their annual gains and distribution. So you typically get a correction there. So yeah, you're going to get a pullback here at some point, and that'll give you a good opportunity to put some more capital to work. But you should not be bearish on the markets at all. There's no reason right now to be bearish on the market in terms of thinking that we're about to go into like the next major downturn in the markets. And I'm trying to bring up a graphic for you just real quick.
Yeah, I do, because right before we turned the camera on, you were starting to tell me this off camera, so I want to hear
Yeah,
the
yeah.
logic.
Right. So again, and we published this. So if you follow me on Substack at Lance Roberts, or you go to realinvestmentadvice.com, and follow me there. Every week we publish our weekly bull bear report, which I know Adam also publishes on his Substack as well. But in that newsletter is a very important graphic, and I publish this. I update it every week, and I publish it. Now, I have to explain this a little bit. It's a little bit complicated, so just bear with me for a second, but you'll get the gist of this. But this is what we call our risk range report. And what this measures is it measures sectors and markets. So this covers all the basic sectors of the S&P 500, dividend stocks, equal weighted stocks, small cap, mid cap, international emerging markets, gold, dollar, gold miners, and bonds. And what it looks for each individual sector and how does it normally trade in a given month. So just say, for instance, that basic materials, on average, historically speaking, going back through history, on average gains or loses 1.5% in a month. So it kind of looks at its volatility, and then it looks at how that sector is performing since the end of last month. How is it performing? And so if it starts to trade outside of its normal volatility range, then it's overbought and you're likely going to have a correction. If you're trading below that long-term range or outside of that normal risk range, it tells you there's probably an opportunity to buy that position. In other words, it's oversold. But where I really want you to focus is on these last three columns. So this first and second column are the deviations from the short-term weekly moving average. So this looks at two weekly moving averages, a 13-week moving average and a 34-week moving average. So this is very slow to move. This does not move quickly. So this is not for traders. This is for asset allocators. So what you're looking for is when markets deviate too far from their longer term moving averages. Moving averages are like gravity. So if I get too far from that moving average, eventually gravity is going to pull that price of that stock back to that moving average or below it in time. Now, it doesn't, again, these are weekly, so it doesn't mean tomorrow, but at some point you're going to have a correction back to that moving average. So when these deviations, like for instance, communications are trading 12% above their long-term average, whenever you're above 10% above your long-term moving average, that's kind of a warning to take profits and rebalance some of your risk. Technology stocks are 12%. Healthcare's 10%. Discretionary stocks are trading 10% above the moving averages. So that's a great thing to look at and say, okay, I need to go in and reduce that risk to the portfolio. And that doesn't mean sell everything. It just means just rebalance it back to target. Just like I did with Oracle in the crypto and the AI model, it has a 5% weighting in both those portfolios. Excuse me. That move took it to 6.5, so I trimmed it back to 5. Didn't sell it, still own it, just took some profits. Gold miners right now are 36% above their long-term average. So again, just these are the warnings that come from this. Now, so what I want you to pay attention to though is this last column. This last column is the crossover of those two moving averages. So when the short-term moving average crosses above the long-term, that's a bullish crossover. When it crosses below that, that's a bearish crossover. And so those are kind of a signal for the markets or for those sectors. At the end of 2021, we had about 14 of these sectors being bearish. When you start getting numerous of these sectors having bearish crossovers, that's a good indication that markets are about to go through a corrective phase. And of course, 2022, we had the 20% correction. Last year, we had a few of these being in bearish crossovers. We had about 10. And so there was some worry that this year that markets were going to struggle a bit, have a bit of volatility, which we did have. But since the April lows, this market has rallied so strongly that we've now reverted all those bearish crossovers, except for 3, back into bullish ones. The point about that is that when you have numerous markets on bullish crossovers, it's very hard to have a big correction in the markets. So we won't have a 20 or 30% correction in the markets unless some event shows up, like a credit event or some type of economic shutdown, whatever it is. It's got to be pretty substantial. Because right now, the bullish bias is behind the markets And all those moving averages are now providing lifting support for the market. So we can have 5 to 10% corrections. Like a correction back to the 200-day moving average right now would be about 9% or so. So a 5 to 10% correction would be completely normal in this market, but it's not going to devolve into a much bigger correction until you start triggering more bearish crossovers in the market. And that's why this table is so very important when it comes to allocators, because what this table tells you right now is that you need to be primarily allocated to equities and holding that exposure for right now and just managing the risk. It doesn't mean just blindly hold it, manage your risk, but take profits when things are really overbought, really extended from kind of long-term means. When they're very oversold, buy them back, add them back to the portfolio, increase your exposure. But being really negative on the markets is going to be a loser bet here for a while.
Okay. Might be a poor analogy, but this is almost like a CAT scan of the market,
Mhm.
which says, hey, barring this guy gets in an accident, he's actually pretty healthy right now. Versus if that thing was riddled with bearish reds, you'd be saying, hey, look, there's something internally, metabolically that's
Yeah.
not unwell about this market. Yeah.
Well, yeah, and think about it this way. If you're really healthy, right, and you come down, then just say you come down with the flu, right? You probably survive the flu, right? And so you go to the store, you get a flu shot, and you're sick for a couple of days, and you feel better, but your body fights it, and you're okay. That's kind of where the market is right now. It could handle a flu at the moment and be okay. But if you're really sick, you've got a lot of morbidity issues, and then you get the flu, it's a potentially different outcome.
Exactly.
And
That's exactly the analogy I was thinking of.
yeah,
Yeah.
yeah, and that's really kind of what we've got going on here. Is this market's super healthy right now. There's lots of little pockets to be concerned about. I'm not saying you should be concerned about the pockets, and that's why it's important to manage risk. Position size in your portfolio, learn to take profits, learn to buy things when they're oversold, those type of things. But being hugely negative and being primarily in cash, that'll hurt you more right now than being allocated to the markets.
So I just want to pair credit spreads with this, Lance. And
Yeah.
yeah, we can have the debate that maybe credit spreads aren't as accurate an indicator as they were in the past. But from what they're telling us right now, they're telling us there's nothing to systemically or to worry about the market systemically right now because they're so tight.
Yeah, and I wouldn't say that, they're not as good of an indicator as they once were, because I don't think that's true, right? Credit is very sensitive to changes in economic dynamics. And again, this is the problem with a lot of the narrative that's out there about, bonds and stuff. It's like, oh, it's the debt and the deficit. That has nothing to do with bonds. It's about really economic growth, inflation, those type of things. That's what drives yields, and that's why yields have been dropping very sharply lately. This morning we cracked 4% on the 10-year yield on the back of this latest inflation data, because all the data we're getting, these employment revisions we had on Tuesday, 911,000 fewer jobs than expected. The PPI data yesterday was really weak. The data today from CPI came in weaker than expected. So everything is suggesting that the economy is slowing down much more quickly. And take a look at what's going on with multifamily in particular. There's a lot of demand drop for multifamily housing. And that is also symbolic of kind of what's happening with the underlying economy. So that supply demand imbalance is really starting to show up here. And credit spreads aren't yet reflecting that. And, but it's going to come at some point. Credit spreads are going to start to widen, particularly between junk bonds and, say,
Yeah.
Treasury yields. I'm sorry, go ahead.
I'm just saying that's one of the easiest predictions ever, only because there's no daylight between them right now. They've got nowhere to go but
Yeah,
wider
but
at some point. Yeah.
but in particular, junk bonds, importantly, will reflect concerns over economic weakness, because it is a proxy for kind of a performance chase, right? High yield is basically a proxy for the stock market. So if the stock market starts to reflect problems, it's going to show up in high yield, and we'll see those spreads start to blow out. But again, they're not showing anything right now, and that
Right,
is
which was my
reflective of,
point. You pair that with your CAT
yeah,
scan there.
yeah,
Yeah.
Exactly. I mean, there's no, and again, that's also a reason from the contrarian investor part of me, which I am a contrarian by nature, is that when everybody's betting on a bull market, that's a time to be a little bit more cautious. And again, we're taking profits, reducing risk, rebalancing. We went into, the all weather portfolio. We trimmed back on our gold miners a bit because they just had just this massive run here and they're very, very overbought. So again, take a little bit of profit there. And we're holding that cash. And then when things pull back, we'll certainly, reallocate that money back to that sector. So, but that's just part of navigating the market. But when everybody is this bulled up on everything. And again, you try to tell somebody, oh, you shouldn't, don't sell Oracle here. It's going to keep moving up, right? You try to tell somebody to take profits in Oracle or gold miners or gold or anything else. They're like, oh, that's hogwash. That's libelous. Don't say that. That's just because we're so optimistic about everything that's also a risk to the market.
Yeah. Oh, and that was kind of my question earlier, which is, are you seeing the signs here that the party has gone into just, full blown, throw care to the wind mode, and it's time for a guy like you to be like, hey, yeah, I'm not selling out of all my positions here, but I'm going to start capturing some of these gains because I don't think this can go on forever.
Yeah, no, but and again, yes, the answer to that question is yes. We just had that conversation this morning. Is that, we've got some positions in our portfolio that are up, 70, 80, 90, 120. We got one position up 185%. So, there's certainly some reasons to go in there and start harvesting some of these profits. And we're going to do that. Timing of that is a little bit of what's coming, is how we kind of time that out over the course of the next month or two. There are a couple of things coming up that I think are worth being aware of, which is you're going to have end of the quarter rebalancing at the end of this month. And if you take a look at, kind of the way things have performed lately. So for instance, if I run a small cap, mid cap portfolio, which we have a model of that. If I run that kind of a model, there's stocks in that model that have risen 70% in a couple of months. That is put a lot of these managers overweight in those positions. So they're going to have to come in and sell some of those and bring those back to target weights. And then they'll rebalance them in the rest of the portfolio. So there's a risk and again, that's the same thing with a lot of large cap stocks, mid cap, small cap, same thing with gold miners, same thing with, basically any type of fund right now, because they've all run very similarly, is that the risk into the end of the month is that you're going to get some selling pressure to rebalance portfolios back to target weights as we head into October for quarter three. The other thing over the next 2 weeks is that we lose stock buybacks starting next week. So the window closes for stock buybacks next week. That's going to take another buyer out of the market through the end of October before those come back. So there's a couple of things at least worth kind of looking at over the next 4 to 8 weeks of, just potential short-term volatility risk where, you get a bit of a pullback. Again, not saying the markets are going to crash 20 or 30%, but a 5% correction would be completely healthy. It'd be normal. Could be as much as 10% back to the 200-day moving average. That'd be completely normal. But because we haven't had any volatility, because we haven't had any pullbacks lately, a 5% correction is going to feel like a 20.
Right.
Right. We'll be on this show and it'll be talking about, man, it's like this market's just falling all apart. Right. And, the AI trade's dead and, we'll be down 5-6%, but it's going to feel that way. And it's going to feel like, oh my gosh, the bull market's over. But that's probably not going to be the case because we hit the end of this year, November, December. Hedge funds, mutual funds, pension funds, professional managers, they're all underweight equities, and they're also underperforming the major markets. So there's likely going to be a big push into year end to try to get performance and allocations up before that year end reporting.
All right. So let me ask you this then. So I think we checked in mid-year. And I think at that point, you guys hadn't raised your price target for the S&P for the end of the year,
Right.
Even though the market had rallied really hard from the April lows, because if I remember correctly, you said, I don't think volatility is done yet. I think it's going to continue to be a volatile second half of the year. Are you thinking of raising your price target towards year end based on what you just said there?
No. because again, I think that it's very kind of possible that by year end we may be a little bit higher than we are right now, but and I could look, I could be entirely wrong, right? This could
Sure. I
be a
mean, that's the forecasting business. You always have that risk, right? Yeah.
exactly right. So, but I said at the beginning of this year, I said, hey, expect a lot more volatility, lower returns, and so far we've had lower returns than we've had the last 2 years. We've definitely had a lot more volatility this year than we've had the last couple of years. But yeah, I think that potentially between now and year end, we get another little bit of a correction, and then we kind of wind up about where we are now, which is not too far off of our target. So, where where the market is a little bit higher than our target right now, but again, it's kind of irrelevant. If I'm trying to produce a 6% annual rate of return over the long term, that's my goal. And so, with the market up 10, it's up 10, 11 right now for the year. We get a pullback and then we rally back up. Maybe we wind this year up at, 12, 13% for the year. We'll see.
All right. Let me ask you what might be a tough question, but can ask it anyways. So you wrote a very important piece at the beginning of the year,
Yep.
right? Titled Curb Your Enthusiasm. Folks are very enthusiastic now.
Yeah.
If we end up over 10%, to be honest, that's a year to be enthusiastic about.
Yeah, it is.
So would you change the tune now to say, hey, maybe you should start, maybe it's okay to be somewhat enthusiastic?
Well, again, and the purpose of that article at the beginning of the year was just saying, hey, look, because we've had 2 years of 20% returns in a
Right.
row, it's unlikely that you'll have a third. And it doesn't mean it can't happen. But I said, we're probably going to have more volatility this year, which, we had a 20% drawdown just a couple of months ago. Everybody's forgotten about that.
It's been a much more volatile year so far. Totally agree. Yeah.
But yeah, nobody remembers that 20% drawdown. It's like, nothing
Yeah.
happened.
I mean, it
Um,
felt like the world was ending to them if we went back, 4 months. But
exactly.
yeah,
Well,
ancient history now.
exactly. That's human psychology. But yeah, no, I think you should be enthused. I think you should be optimistic about the markets. Markets are, the underpinnings for the markets are okay. There's certainly some pockets of risk, certainly some pockets of worry that I think you need to be paying attention to. But I think as long as you're just managing your risk and managing your exposure and just not being, overly optimistic and overly bullish, I think you'll be okay. And again, I think we're going to see another bout of volatility for the end of the year. Volatility is very compressed right now. Credit spreads are compressed, volatility is compressed. You take a look, we got a kind of a break between the VVIX and the VIX, which typically leads to an uptick in volatility. So I think you certainly have the catalyst in place for an uptick in volatility. Again, that would be coincident with a 5 to a 10% correction somewhere.
Hmm.
Um, and again, we get to the end of the year and you look back and it's like, hey, the market was fine, but there was a whole bunch of bumps along the way.
Yeah. Yeah. Okay. Well, let's see. Let's move on here. You started talking about the latest inflation data. So that's next on my list here. So maybe, continuing a little bit with gobsmacked, there's a lot of people out there who, I think I've told you many times on this channel, Lance, that because I interview so many people, I can see the topics where there's lots of consensus on and lots of division. And the one
Mhm.
for the past year that's been by far the most divided has been what's going to happen with inflation.
Right.
And, a lot of people, certainly in the financial media, who have said, look, tariffs are a tax, they're inflationary. We're going to have all sorts of, secularly high inflation going forward. And the more data we get, I mean, the final answer isn't in yet, but the more data we get is that we are not seeing a lot of price inflation being pushed through by the tariffs.
Yeah.
And you already mentioned most of the data points I was going to mention. I actually haven't had a chance to see yet today the new CPI data, but it sounds like you said it came in lower than expected.
Yeah. Expectations were 0.3, came in at 0.2. The year-over-year inflation rate dropped from 2.9 to 2.7.
Okay.
So,
All right.
but again, I just, it's a great point that you bring up. And I just wanted to point out that not everybody in the media agreed with that. There was this guy that wrote this article in November of 22nd of 2024 talking about how tariffs are likely, the risk to inflation from tariffs are likely overstated. And, we laid out all the data for that back then. So, while all the media has been running around pointing to, oh my gosh, tariffs can cause inflation to soar. there's really no historical evidence that ever occurs. So again, the how things have actually played out was exactly kind of what we've been saying would be the case over the last year.
All right. Yeah. Well, hey, if you hadn't taken the victory lap yourself, I was going to let you take. I was going to hand you the baton to do it.
Thank you.
No, you've been very consistent on that. I remember several months ago you did a detailed analysis of the Trump 1.0 administration's tariff policies and how those didn't result in inflation. And look, the final chapter isn't written yet,
Yeah,
but
yeah.
it does seem like what you have been predicting is unfolding. And another question I've been asking people a lot, Lance, is. Okay. There are, I think you can make an argument for um, higher like inflationary ingredients going forward, especially as we reshore jobs to America, right? So we remove it from super cheap labor locales to here. Um, there may be, some commodity as the world competes more now for certain commodities, there might be some commodity input inflation. Cost of capital is higher, things like that. You can make sort of okay, I can understand some secular arguments for those things. But at least in the near term, let's say the next 6 months, 12 months,
Mhm.
if there's a slowing economy, which wins out, right? The demand destruction of a slowing economy, possibly a recession. Not saying we're going to go into one, but there's the potential we could if the economy slows enough, and the data is showing the economy is slowing.
Yeah.
So, which wins out? And I know you're on the side, Lance, of, oh, I think the slowing economy wins out. And that's one of the reasons why you guys have continued to sort of have your position,
Mhm.
the stance that you've taken with bonds, because you expect bond yields to come down as a result. Interesting to me, not everybody still is willing, not everybody sees it the same way.
Right.
Um, but you still see it that way, right?
Well, yeah, and we actually had this conversation this morning. So when I was doing the real investment show this morning, we kind of dove into this. Inflation hadn't printed yet, so I do my morning show from 6 a.m. to 7 a.m. in the morning Central Standard Time, and so economic data prints at 7:30. So we were talking about inflation before it came out, and this is the thing that I think most economists, like the vast majority of economists and people like Ray Dalio and others have completely overlooked, is the construction of CPI. And there's two critical points about CPI. So again, one of the pushbacks about CPI when we talk about inflation is like, well, have you been to the store lately? The cost of eggs or the cost of bread or the cost of these things have all gone up. But that's okay. Those prices can rise, and you can certainly have inflation in that manner for if I'm trying to just make ends meet at home and my groceries go up by $100 a month. That's certainly an impact on my livelihood and my standard of living. I'm not arguing that point. But when we start talking about inflation as an aggregate indicator for the markets, it's a different ball of wax altogether.
Right. And sorry to
And
interrupt, but yeah, motor vehicle parts could go up by infinity and it wouldn't matter to the
right,
index, right?
because it's zero, it's got a zero weight. And if you'll notice, there's a couple of things in here that are missing, right? There's no oil prices in here, right? Oil prices are tucked into things like transportation services, ex-public, these type of used cars, new cars. That's where energy gets plugged into that mix. So, so we don't have a drop here for what's oil prices. So we talk about oil and say oil's going up. So that's inflationary. It does impact inflation, but only from the standpoint that it impacts the components of CPI that are affected by the price of oil. But here's my important point. There's two components in here that make up a vast majority of the CPI calculation. Owner's equivalent rent down here at the bottom, 33% of the index. Rent of primary residence is 9%. Add those two together, that's 42% of CPI. So what that means is that you could have virtually everything else in the CPI index go up, and if homeowner's equivalent rent and rent of a primary residence go down, and that's what we're seeing going on right now. Look at the housing data, look at the rental data, look at the Zillow data. You just had Melody Wright talking about what's going on with the housing market.
Mhm.
That's not inflationary, and all that imputes into 42% of the index. So everything else, lodging away from home, could go to the moon, but it's 2% of the index. right? Pets. I can tell you for a fact, my vet bills for my two dogs have gone up, but it's 1% of the index,
Right.
right? So everything else could go up, sharply. But if you have a drop in 42% of the index, inflation is going to decline. So really the only thing you need to be paying attention to, if you want to know where bond yields are headed, pay attention to homeowners equivalent rent and rent of a primary residence, because that's going to show you where yields are going.
All right. And so on that, folks, for the few of you that haven't watched it, because it's been one of our most watched videos in months, the Melody Wright interview that Lance just mentioned, you should go watch that, because if you've got the counter argument that, okay, I think actually home prices are going to go up from here, you get to have a real empirical, convincing argument to counter all the data that Melody
Okay.
brings to the table.
But hey, look, I can tell you right now, I do hard money lending for real estate. It's one of my side hobbies. And I can tell you right now that these guys are chomping at the bit for yields to come down. And they're just looking for the Fed to cut rates because that improves the capex rate on real estate. I'm not so sure that Fed rate cuts by themselves are going to solve the problem you've got going on with multifamily and the general housing problem right now. And maybe I'm wrong. Maybe we'll see a very robust recovery if we can get mortgage rates down. But one of my arguments well, I shouldn't say I'm not arguing, the issue with housing. I'm not saying that at all. I guess a better way to say is one of my concerns about housing is that when rates come down enough to where people that are locked into their house can go afford a mortgage to buy a new house, you get a big dump of inventory on the market. I think that's the risk that a lot of these kind of real estate investors that are just chomping at the bit for rate cuts to go buy real estate. I think that's where and look, I could be entirely wrong. Maybe they're right. They
You think
certainly
they
got a
may
lot
be
more
ignoring that
experience
risk?
than they've got a
Yeah.
lot more experience in it than I do. But the historical evidence is that yeah, every time the Fed cuts rates, yields come down, real estate goes flying through the roof. It's great, right? Maybe this time is different because of what's going on with housing in general and affordability and those type of things.
All I'll say, Lance, is that Melody, who lives and breathes this stuff and came up in her career through the mortgage lending part of the market, agrees with you here.
Okay,
Yeah.
we'll see. We may be both wrong, so we'll see.
All right. So anyways, I think an increasing number of people are starting to scratch their heads and say, wow, like maybe my base assumptions on tariffs being really inflationary were wrong. And I'm curious, if enough of the market changes their mind on that, Lance, what impact, if at all, do you think that would have on the market? Would
Well,
that make
the
people
stock
more
market,
bullish, less
what stock market or bond market?
both?
Okay, so I posted this chart this morning. So let's talk about stock market first, and we'll talk about the bond market. I posted this chart this morning on X. So this is GDP versus corporate profit margins. If you'll notice, there's a very high correlation between corporate profit margins and GDP going back historically, which is exactly what you would expect, right? Because corporate profit margins are a function of supply and demand, right? I've got to generate revenue, offset my expenses. I wind up with my net cost, and I've got to have a lot of demand so that I can expand my margins, right? So there's your inflation argument. If I have a really good market, I can increase my prices, expand my margin, and I get inflation in the economy.
Mm-hmm.
The problem is that do you see that big gap right now between margins and the economy?
I do.
That's
Biggest
my
we've seen.
concern. Sorry?
Biggest we've seen in this data series, which goes back 20 plus years.
Yeah. And you'll notice that back in 14, 15, you had a similar divergence, and back in 12, 13, you had similar divergence. And in both cases, they caught down to economics. The issue is right now we have a lot of profit margin expansion because of cost cutting, labor hoarding, layoffs, those type of things. We're seeing a lot of temporary hires versus full-time hires, which those are cheaper. AI increases in productivity, but we can increase margins by doing that for a while, but those are very limited options. I can't do that forever. I can't take, like, for instance, we have 32 employees. I could not reduce our employees to zero and still run the business,
Mm-hmm.
right? It just won't work. So Yeah, and by the way, if any of our employees are watching this, I'm not, we're not, we're not laying anybody off. We're fine. I'm just using this
Good,
example. So
good
nobody freak out.
qualification, important
Every,
qualification.
your jobs are fine. Don't worry about it. But no, if I could replace employees with, artificial intelligence, an example, there's only so many of those jobs I could ultimately replace. I could replace a few and maybe increase my profit margin somewhat. But my point is there's a limit to how you can keep doing that. And if the economy keeps slowing, you're going to have a contraction in profit margins. The other thing we talked about recently is that earnings estimates are way too elevated, very optimistic. Well, we're already starting to see those estimates for Q3 and we're about to start Q3 reporting. We're already seeing those estimates for Q3 and Q4 come down fairly sharply. 2026 is still elevated, but I expect to start seeing that come down as we get later into this year. Because again, earnings and revenue and margins and all that come from economic growth. And if the economy is slowing down and is going to continue to slow down further, which is kind of what I expect to happen as all that, our pig in the python has now left the system. Elvis has left the building. I think we're going to have slower economic growth, and that's going to wind up closing that gap between margins and the economy. And that's not going to be good for the stock market. And so, tariffs are a function of that. And if tariffs can't be passed on by producers to consumers, and again, the only person that pays a tariff is the producer. So if those producers can't pass on that tariff, that's going to start eating into their margins, right? So then we're seeing that now. We saw that in the PPI report yesterday.
Right.
That ability to pass on those tariffs is really getting squeezed, and producers are having to eat a lot more of that tariff than I think they originally intended. So from the stock market, I think it's a negative. And that's why I think that there's potential risk to the market in 2026 as we get out there and we start kind of seeing reality align around earnings. Because remember, valuations are fine where they are right now until you start challenging earnings. And I think next year we'll start talking about a more challenging environment for earnings going forward.
All right. Hey, two things before
Go
you get to
ahead.
bonds. One, Michael Howell, liquidity guy, liquidity guru, God, sort of agrees with you on that outlook. So just wanted to connect that dot. And let me ask you this question that Stephanie Pomboy brought up yesterday or 2 days ago, and you may want to include how this impacts bonds as well. She made a really great point, which is that as we or during the era of globalization, when we pushed all of our manufacturing off onto the rest of the world, we sort of were able to push the business cycle,
Mm-hmm.
exposure to the business cycle off of our shores.
Right.
The booms and busts of the manufacturing cycle, all that stuff, they felt the brunt of that. We didn't feel it nearly as much, which I think is one of the reasons why we've had so few recessions since the globalization era started compared to before. And
Yeah.
so her point was, hey, we got to be aware that as we begin to reimport that, we will be reimporting exposure to the business cycle here.
Yeah. And again, when you take a look, so I run a lot of composite indicators, and one of those is the composite indicator of ISM services to ISM manufacturing. And then we weight that relative to the economic makeup. And so right now, that economic makeup's about 75%-ish of services to 25% manufacturing. Well, manufacturing is very economically sensitive, right? It's a big multiplier effect on the economy. If I manufacture something, I get a $3 to $4 multiplier in the economy versus services. I get basically a 1-to-1. It's a very low multiplier. So as we start to onshore more of this manufacturing, and it's kind of one of those things that at the end of the day we may go, this is great. We're gonna bring jobs back to America. That's awesome. Until you start getting a much more robust economic cycle of like you said, these booms and busts. Because when there's going to be a slowdown in manufacturing, that's going to have a much bigger impact. Let's just say we go to a 50-50 spread between manufacturing and services. All of a sudden, that economic cycle is going to get a lot more volatile because of that input that manufacturing has on the economy.
Right. It punches way above its weight relative
It
to
does.
services. Yeah.
Yeah.
Okay.
In
All
both
right.
directions.
All right. So sounds like you concur with Stephanie. Okay. So
Yeah.
bonds.
Oh, for bonds, again, when we kind of look at what's happening with inflation, what's happening with the economy, that's a very good bond friendly environment. And again, if we start to see a risk off environment for stocks, it's going to look for safety and income, which will be in the bond market. The other big benefactor of bonds going forward is that there is a absolutely massive short position against both ETF bond ETFs as well as the individual treasury bonds. Commercial traders are very, very short bond exposure. So if we start getting really much below 4% on the 10-year treasury, there's a real risk that we could see a very sharp downturn in yields, like head towards 3% pretty quickly. If we start getting into an environment where economic growth is really starting to show weakness, potentially recessionary, if that begins to show up, if we begin to see credit spreads blow out, those shorts are going to have to cover, and you could see a very sharp drop in yields in a very short period.
Okay. Since I sort of pushed you to prognosticate, I'm going to do it again here. What odds do you give a recession at some point in 2026, given what we know now?
Um, Predicting recessions are extremely hard
I
for a
know.
whole variety of reasons. And we can have recessions and not actually have them classified as recessions. We've had those
Hmm.
before, like 2012. But a recognized recession in 2026 is probably rising. So give it a 30% probability right now.
Okay.
But
30% probability that in 5 years, when we look back at the chart, 2026 will have a gray line on it.
yeah, it's that. But again, I think that risk could certainly go up. A lot of it's going to depend on really this economic cycle, the when you start looking at the employment data, full-time jobs versus the total working population. I showed you that chart last week.
Hmm.
You start looking at, things like services and manufacturing, which are barely just, services are barely holding on to expansion versus contraction. Manufacturing's been in contraction for a while. I think there's certainly a rising risk that 2026, 2027. Now give me 2 years, 26, 27. I think the risk of a recession rises pretty sharply.
Okay. Okay. And, as we've been saying, and we will continue to track real closely, folks, the momentum on the job side is downwards. And that's peering through a lens that is very smudged, right?
Yeah.
The jobs data has been really, really hard to have a lot of confidence in.
But let
All
me let
right.
me let,
You go
let me
ahead.
say something real quick about this, just because I've said this on the show before, and I just want to stay true to what I said, a forecast should be. Forecasting anything that far out is meaningless. Right? We're just having a conversation. You should not bank anything on that. I cannot. So, a good forecast I always say is you gotta have a time frame. It's going, we're gonna have a recession by January the 1st. It's going to be a 30% correction in the markets. It'll be over by October and you need to be buying back into the market. I'm not saying that at all. Right.
Yep.
I do not have that kind of visibility on anything, because of the economic data and the way it moves. There's no visibility on that. We saw 2022, everybody expected a recession, never occurred.
Right. And I'll remind folks, as you remind us all the time, that the headlights on your operation look at about 1 to 3 months,
Yeah,
right? And so you're saying, look, from what I have confidence that's going to happen in the next 1 to 3 months, that's what I'm playing for now.
yeah,
Yes, I maybe my gut tells me that in a year this could happen, but I'm not going to worry about it until it starts appearing in my headlights.
exactly. And then when it gets there, we'll adjust the portfolio. We'll sell stuff, buy more bonds, whatever. But yeah, we're
Yeah.
just not there yet.
Okay. Back to stocks just for 1 second. Again, going back to our theme of head scratchers here. Um, I pulled this from a report. It says, despite record buybacks, the impact from stock repurchases is fading. The S&P 500 net buyback yield has declined to 2%, the lowest level in 2 decades outside of recession. One consequence of a declining buyback yield is less earnings per share accretion and slower earnings per share growth. Weakening buybacks also indicate less share price support from corporate demand. So this has been a massive driver of share price appreciation, buybacks.
Yep.
They're continuing to happen at record levels, but it's potentially, Lance, are we beginning to enter an era of diminishing returns where it takes more stock buyback to get the same oomph?
Yeah. I mean, it's just like, excuse me. I've been having a challenge with my voice today. I apologize. No, it's the same thing we're seeing with QE as well, right? So anytime that you do something repeatedly over and over again, and the environment that you're doing it in is expanding, just by sheer logic, it's going to take more and more to get the same effect. And we saw this. So, for
Yeah.
instance, when we did QE1, we did about $1 trillion worth of QE, and we had this massive move in the market. Each successive round of QE, it required larger amounts of QE to get the same bang for the buck. And that just makes sense, right? Because the market's getting bigger.
Yeah.
So to move
Is
that
it
volume
just the
quick.
law of large numbers, or is there a sort of, it builds up a resistance, or it just works, its potency decreases over time
Well,
too?
yeah, but for the same reason, right? I mean, if I'm dropping water into a glass, right? And I'm gonna have to keep putting more and more water into the glass eventually to
No, no, I get that.
yeah,
That's the law of large numbers.
yeah,
I'm
yeah.
just asking, in addition to that, is there also the system just
Oh,
stops?
yeah, yeah. No, I think that the other side of that is that also the market gets, when the market starts expecting something to occur, it starts discounting it. So you don't get as big of a push from that same activity because the markets already know it's there and they already
Right. So they've
expect
already
it to
priced it in before you've
yeah,
done it. So when you do it, it reacts less.
correct. Yeah.
Yeah. Okay. So I guess my high level question here is just, is there any reason to worry that one of the big pillars, propellants of asset prices may not do as much going forward?
Yeah,
Or
no,
will companies just write bigger and bigger buyback checks? I mean,
well,
that's
and we've been doing that. We're going to cross well over $1 trillion this year in buybacks for the first time ever, and that number just keeps increasing every year. And it's interesting because there was an article out this morning, and this is kind of the same thing that happens is that when somebody starts doing something, everybody starts going, "Oh, that's working for them. I'll do that too." Right? So, Apple and Microsoft and Google, they were doing buybacks, and Nvidia goes, "Oh, okay, I'll do buybacks too."
Mhm.
And so everybody starts doing that. It's kind of the same thing with, MicroStrategy was doing the whole Treasury kind of management with Bitcoin. And then we've seen a lot of other companies start jumping on that train.
Like that one I mentioned at the beginning here, QMMM or whatever it is. Yeah.
Yeah. And so everybody jumps on that board. And so now what we're seeing is that there's becoming less and less effect because you're getting a dilution of the effect. Everybody's like, "Oh yeah, yeah, everybody does that now." And it becomes more dilutive over time. So again, yes, the answer to your question is yes, it's going to continue to take larger and larger buybacks to get the same net effect. One reason is the market's just getting bigger. Market capitalization is going up. So to move market capitalization, it requires a bigger push of buying.
Yeah. And we'll move on, but just re-ask my question one last time.
Yeah.
Sounds like right now you're not worried that buybacks as a support of their contribution to the support of the market is not going to decrease materially enough for you to worry about this yet.
Not yet.
Yeah.
What I would be more concerned about is when companies go, "Yeah, we're going to cut back on our buybacks." Right. That's when, if we start seeing a reduction in the buybacks, that's
Hmm.
where I think you really start worrying.
Okay. So sort of the corporate version of the giant mindless robot.
Yeah, exactly.
Yeah. Okay. All right. Let's see here. I'm throwing a lot of stuff out of the balloon right now just to make sure we can get to our end in time. Um,
Oh,
any
by the
update?
way, my
Yeah.
interview got canceled, so I'm a little okay on time.
Okay, good. I still have a bit of a back end, but we'll go as long as we can here. Um, so uh, there's been an increasing amount of interest in stablecoins and
Mhm.
their role that they look like they're going to play in supporting the U.S. Treasury market. Um, Anything happen in recent weeks that we haven't talked about yet that's on your mind about this, Lance, in terms of the influence this may have?
No, no, we've been looking at nothing's changed. We actually wrote an article, I can't remember now, a month or two ago. I think it was one of our daily market commentaries that we wrote that, talk about, how stable coins could be, the next big kind of beneficiary for the bond market. But yeah, nothing's really changed from that standpoint. What we need to see is that adoption really start to get picked up, and we haven't seen that yet. But it is encouraging that if we start to see more of an adoption of stable coins and more usage of that through the economic system, it could certainly be a beneficiary to our bond portfolio, which we would like very much.
All right. And let's see here. Just a headline I pulled this morning. We just had a blowout 10-year auction, lowest yield since last September's 50 basis point jumbo cut, near record foreign demand. I guess I put this in here again as sort of a head scratcher, because there has been this narrative of nobody wants treasuries anymore. That's why central banks are all buying gold, and foreigners are all angry at America, and they're not buying our debt anymore, and they're all trying to find additional ways to transact with each other. And basically, the treasury market is not going to be what it once was going forward. Still seems like
Which
it's
we've been
fairly healthy
saying all
right now.
along. Right, which we've been saying all along is none of those narratives are true. They're great for headlines, but those aren't true.
Yep.
Yeah. Even the data never supported it. We've always had good foreign demand for bonds. Foreign holders of bonds haven't really changed much. People saying that fiat currency is going away are completely wrong. That's not occurring at all. There's still 70 to 80% of all foreign transactions. So, again, all these narratives are great. Generally, they're by people pushing gold, trying to sell gold in most cases, or trying to promote a gold fund that they run or whatever. But there's no actual basis in
Yeah.
reality for those statements.
Just to be clear, I hear a lot of that narrative from not gold people as well. I mean, it's pretty prevalent in
The
a
do-
fair
the
amount
yeah
of the
the
media.
bunker crowd for sure.
Yeah.
Yeah, yeah. I mean, if you're betting on the end of the world, then it makes a great narrative. The problem is just the data's never supported it. And again, it's great if I'm trying to push fear, to sell a product or to get clicks and views or whatever. If I'm trying to do that, then those are great narratives. But yeah, I got this really great email the other day from a guy, and I never really thought of it till now, till he mentioned it to me. He says, "Have you ever noticed that in all the end of the world zombie movies, nobody's trading in gold?" And I was like, I never really thought about that until then. But yeah, it's just kind of the statement. But yeah, I mean, it's, look, there's, going back to the very basics of everything, you know, owning gold is fine, owning, stocks are fine, owning bonds are fine, owning cash is fine. The only thing that matters is that asset creating a return on investment large enough to offset the real rate of inflation, so we have the same purchasing power in the future. That's all that matters at the end of the day. And worrying about things you can't control, like the end of the world, economic collapse, economic ruin, you know, you look at the globe today, right, as a good example. This is probably more for a rant one day, but you
Yeah,
look at
you're
the
ranting because I'm not talking about economic ruin here. But anyways, finish
well,
your
I know,
point.
I know you're not, but this is the narratives that I get a lot of, right? People say, I don't understand why you own stocks because the world's going to end. What's interesting to me, we talk, there's a lot of this headline about this coordinated global reset. And it's all, there's all this conspiracy of these people out there that are all getting together in this cabal and they're going to do a global reset on everything. We can't get two people in the same room to agree with each other, much less get governments to agree with each other on a coordinated reset of the global environment. It's just these are just ludicrous ideas, and they're great for selling points, or great for selling books, or websites, whatever. But you just have to come back to the reality of what can I control today. And some of these things, sure. Could we have a complete global reset at some point and the world absolutely come to an end and everything fell? Yeah, maybe, but it might be 300 years from now, right? We can only deal with the time frame that we have today. And our time frame today is to do one thing, and just to make sure that our retirement is secure and that we're growing our assets at a pace to make sure we can meet our retirement goals. And how you choose to do that is up to you, and it's completely fine. There's no right way, wrong way to do it, as long as it's work. The only wrong way to do it is if it's not working for you. If it's not working for you, it's the wrong way to do it. If it is working for you, that's great. Then there's nothing wrong with it. And again, this is why we just go back to the basics of manage risk. You're going to have corrections in all asset prices. Just make sure those corrections don't ruin you, because when you lose capital, getting back to even is fine, but you lose the compounded rate of return you need for retirement. And so we've always got to factor that into our cycles and how we
Yeah,
manage our risk.
I don't disagree with any of this. You kind of took it in a direction that I wasn't looking to go in, but those are all important points to reemphasize for folks.
Yeah.
Let me bring it back, and then
Yeah. Yeah.
you opened a door to this question I'm going to ask next in a second.
Sure, sure, sure.
So what I was really just trying to underscore, and I believe you feel the same way, is look, if your investing thesis says, I think bond yields are going to stay higher going forward, we're still going to have higher for longer bond yields.
Mhm.
Um, if a material party or rationale for that is because I think other countries aren't going to be interested in buying our treasuries as much, you really need to potentially reevaluate that, or at least, get data that trumps the data that Lance was just referring to.
Mhm.
And we didn't pull it up this time, but I know probably a month or two ago, we did do one, Lance, where you pulled up a chart of the foreign buyers
Yeah,
for the recent auctions, and we could see that
yeah.
there wasn't a material drop off. And you also have to sort of ask yourself, all right, if the economy is slowing the way that Lance has shown us it is, um, and there is a risk of recession, not necessarily a recession, but certainly a recession makes this even worse. There will be, the question you have to ask yourself is, okay, why wouldn't there be a safety trade into U.S. Treasuries, right?
Mhm.
And remember, if the U.S. is flirting with recession, the rest of the world is probably in substantially worse shape at that point in time. And that foreign capital is going to seek shelter. So you can ask yourself, is there a better alternative today to the US Treasury? Not a perfect asset, but still widely seen as sort of the safest, most liquid asset out there in the world. Yeah.
Right.
Maybe gold catches a little bit of a better bid this time than it has in the past. I can certainly make that argument.
Yep.
But as a guy who really likes gold, I don't think that the Treasury bond has been supplanted as the safe haven asset of choice, especially in a global slowdown.
Yeah. And again, when you look at gold as a function, and you mentioned earlier about central banks buying gold, you got to remember that gold is the reason that central banks buy gold is to hedge foreign reserves. So the dollar's been under pressure. That won't always be the case. The dollar will rally back at some point. Just, we go through these economic cycles and the dollar weakens and it gets stronger and it goes back and forth. But the dollar is trading about where it was, 30, 40 years ago. So, when the dollar rallies, that's going to weigh on gold because, there's a historical non-correlation between those
Right.
assets. So again, it's just, just understand the correlations of different assets and how they work together. And so as long as the dollar remains weak and gets weaker, and if your thesis is the dollar is going to continue to get weaker, that's fine. Just make sure you have data to substantiate why it's going to get weaker. And
Right.
it needs to be,
And some diversification in your portfolio in case it doesn't. Yeah.
yeah, in case it doesn't, but just make sure that your data is real data, not some hyperbole that's,
Right. Not a
put out
headline.
on the internet. Yeah.
Yeah.
Just make sure it's valid. And again, just, so there's very easy, and this is why we run so many correlations. If you go to Simplevisor and look at, performance analysis and all these type of things that we provide, there's all these abilities where you can look at different asset classes and look at the correlations between those asset classes and how they perform historically. And it helps you give you a little bit better way to manage your asset allocation so you can hedge against risk. Because again, that's all we have to do as investors is just I can be long an asset as long as I'm hedging it in some manner, I can control that risk.
Mhm. Okay. And I'm going to start just jump into other topics here real quick
Sure.
so we don't run too long. But you kind of opened the door on this one. So we had the SCO happen a few days ago, and it's the Shanghai Cooperation. I'm now not remembering it. I know I looked it up for another interview I was doing live. But basically, this is where we had kind of the leaders of everybody who's not on Team America meet, Lance,
Yeah.
right? So we had President Xi, we had Putin, we had uh, Kim Jong-il, can't remember
Yeah.
the name of the
Kim
North Korean
Jong-un.
guy.
Yeah.
I always forget. And then we had India, which was sort of a little bit of the surprise here. India is they're trying to split the baby here by telling the U.S. we're going to be your best partner and telling China the same thing, and it's going to be interesting to see what happens there. But
India's
that
playing
that
the
was
smooth
that
card.
was obviously very orchestrated
Yeah.
to show America, hey, look, we know with your tariffs and everything, you're trying to put China in a box and keep Russia, isolated. Hey, we're strong without you, right? Now,
Mm.
whether it's true or not, everybody can debate. And I've got the same caution you do, Lance, especially when folks talk about the BRICS and things like that, which is it's hard to get just two regular people in a room to agree on most things, but to get countries that have uh, at times been adversaries, historically at times,
Mhm.
to all work in unison globally, against big trading partners like the West, which, it's hard to exist as a country on this planet without trading with the West.
Right.
Um, it's a big lift, but this SEO, is the most recent sort of show of, hey, you know what, guys, we don't really need you if push comes to shove. So, anyways,
Well,
any reflections on that?
yeah, look, it's a show of force, and it's kind of like we go at the G7 summits, we've got the G20 summits, and we go to have these summits, and then everybody leaves and resolve nothing.
Right.
It's just kind of it's the same thing that we have, going on. The G7 and the G20 is basically our version of the SEO.
Yep.
So it's just like, hey, we can survive without you guys, but we really need your rare earth metals and your production and
Right.
your manufacturing and everything. So, it's these are all kind of great, kind of shows of strength to say, hey, this is who we are,
Yeah.
which is fine. But at the end of the day, they need us and we need them, and we can try to work our way around that. But again, just the U.S. economy is now very dependent on our imports from China. They're a major trading partner of the U.S., and so yeah, we're trying to tariff them. We're trying to get some fairer trade agreements set up. Eventually, I think that'll occur because it's in China's best interest as well, because they buy a lot of stuff from us
Right.
also. But again, that's going to take some time to work through. And again, this all really comes down to needs and demands and economic growth. And it's great to try to play a strong hand, but if you don't have the ability to sustain yourself on your own, and your economy starts to fall apart, which there's some clear evidence, China's struggling, Europe's struggling. Next year, GDP growth in the Eurozone is expected to be less than 1%. We're expected to be about 2% in the US. That you can't sustain 1% growth in an economy without developing problems.
This was my point. If the U.S. is
Socioeconomic
flirting with a
problems.
recession, the rest of the world's in
Yeah.
worse shape. Yeah.
Yeah. And so all this talk is great, but at the end of the day, it's going to be who needs who for what.
Okay. All right. Okay. Another thing that has some folks in a big industry scratching their heads and kind of gobsmacked. Um, so the president, as I understand, I think has issued an executive order. I'm not entirely certain if an executive order has been issued or not on this, but on new restrictions on big pharma ads in
Mhm.
mass media.
Yep.
Basically, as I understand it, it's requiring the companies to list pretty much all the side effects of their drugs,
Yep.
which kind of becomes prohibitive because your 30-second TV commercial becomes like a 7-minute commercial, right? And also, as the person is listening to all this stuff, they're saying, maybe I don't want to try that drug, right?
Well, have you ever listened to a drug commercial
Well,
like
absolutely.
Skyrizi and some of these other ones?
Let me put it this way. I'll let you ask why you're asking that question. But I remember in the older days, which were not that old, is it would end with the guy speaking at like 5 times, oh, this is great, and you're going to lose weight and get tan, and everyone's going to love you, and then
Yeah, yeah.
right? But I don't think they do that anymore. I
Well,
think what
no,
they would,
but yeah, they listed at the bottom. This is like when you watch these commercials. And first of all, by the way, I'm all for this. I don't think they should be allowed, in my opinion, they shouldn't be allowed to advertise drugs at all. I just think we have too many people dependent in the US on a drug for every problem,
right.
no matter
And just to
what
give
your
some
problem
backstory,
is.
we didn't allow this before. We have removed limitations. Right now, we are, I believe, one of only two countries in the
Yeah.
world, New Zealand being the other, that allows direct to consumer mass marketing of
Yeah. And
pharmaceuticals.
I think it's terrible. I think if we're going to do, we need to have more commercials on how to eat right, how to exercise, how to take care of yourself, good
Yep.
nutrition, those type of things. Because you can solve a lot of your problems just by getting off the couch and getting some exercise, going outside, getting some vitamin D. But, today it's like, oh my gosh, I can't concentrate. I must have ADD, right? So I've got to take a drug for that. And it's just, we've just infiltrated society, with these commercials, and that there's a drug, there's a solution for every problem, and it's in the form of a drug. But if you, if you watch these commercials at the bottom, it says, you know, this drug will help you get rid of, eczema or whatever. And at the bottom, it says, yeah, you may also experience blindness, deafness, explosive diarrhea, whatever.
Right.
It's just all these horrible side effects. I'm like, why would I take that?
Well, and with that being said, like one of the changes that's been made over the past decade or
Yeah,
so is they only have to list some of the side
yeah,
effects. As long as they link to a website or say, go talk to your doctor, that's their get out of jail free card of like, well,
yeah.
you can go over to this website and read the huge long list, right? But nobody does, right? And to the point that they're still putting, they don't have to put everything, but you're still reading these horrible things. You're like, oh my God, what else does this thing do? Yeah.
Yeah, this can kill you, but it'll make you feel better.
Yeah.
The depression drugs are the best because they tell you it's like this may lead to suicidal thoughts and death, but you won't be depressed. Okay, go outside and get some sunshine. That's a good start. But look, I think that so again, if I can't get rid of the commercials altogether, at least yeah, have them list everything and
Okay.
just make it so onerous on the companies. Maybe they stop advertising, and go some other route.
Yeah. So this sounds like I'm trying to make it a rant. I'm not. And I'm right there with you, Lance. You look at when we started loosening these regulations and they started the direct mass marketing and the percentage of Americans that, are now on some drug, it's ridiculous. It's totally directly correlated.
Yeah.
Where I'm going with this is how big of a hit is this going to be to pharma stocks like AbbVie, which is one that you have ridden hard in your portfolio to date?
Yeah, yeah. It's up 4% today. So riding it hard again today. Um, no, look, these companies have done well over time because they're going to get their drugs to market. And again, there's all kinds of movies about how the pharma companies supplement the doctors to get them to sell their drugs, one drug over the other, and there's all that documentation. Look, healthcare companies are going to figure a way around it. So the companies that we're invested in are drugs that consumers demand, right? Botox, which is AbbVie, but
Mhm.
they're both. I don't care if you advertise it or not. Women are going to figure out Botox, and they're going to, they have whole Botox parties where they get together and stick each other in the face to make themselves look younger. That's not going to change. This whole weight loss drug movement with Eli Lilly and those companies, that's not going to change anytime soon. So whether they advertise or not, those drugs are going to get sold. So that's what we look for in particular is drugs that are on a mass market basis that have their own internal drivers and they could get rid of all the advertising and their sales would still continue.
So I agree that their sales would still continue. I think the big question is, by how much, right? And what is the delta? Because I mean, these companies are the biggest spenders on television.
Yeah,
So that does influence demand, right? So
right.
yeah, maybe it grows next year, but would it have grown at 5 times the rate if they had been able to continue that? I'm basically just asking, as a capital manager, are you
Yeah.
reacting to this at all, or are you just in a
No,
wait and see mode?
well, first of all, it's a wait and see thing to see
Okay.
what actually happens. B, we manage those positions in our portfolio. We need healthcare exposure anyway because we track an index. So we need healthcare exposure. So we're very selective about the healthcare companies that we own. And again, we're looking at very long-term track records on these companies and how they've performed over time, look at their fundamental balance sheets, all those type of things. So, yes, if this advertising rule comes into effect and we see a substantial drop off in, their sales, then we'll eliminate the companies or do something differently. But again, that's going to have to be a wait and see type thing, and the stock prices will reflect it before it comes out. So again, we'll start to see if these companies start to really if there's a big concern about revenue growth, the stock prices will start reflecting that concern even before the rule hits.
Okay, and just in terms of any impact, I mean, you mentioned AbbVie's up big today. Did we see any major reaction to this news, or has it been shrugged off so far?
So far, the healthcare sector is doing really well today. AbbVie's hitting an all-time high today. So
Okay.
far, just
All
kind
right.
of
That doesn't sound
kind of
like too
shrug
worried
of
then.
yeah. But again, look, it's one thing that any major sector of the market has, right? Is that they've got their lobby. Healthcare has a huge lobby group. Tech has a huge lobby group. Discretionary companies have a huge lobbyist group. So even when this rule comes in, it's like Wall Street. You can put a rule on Wall Street. And great example of this was in 1999, Bill Clinton says, we're going to cap all executive salary at $1 million. Can't pay an executive more, a CEO more than $1 million a year. Wall Street goes, oh crap, that's a lot of money that we're not going to get from these CEOs of these companies. So we're making as much money. Let's figure out a way to help them make more money. And they go, hey, how about stock option compensation?
Hmm.
And then we started this whole 3 decades now of just stock option compensation, and now that's the majority of executive pay. It's great for Wall Street, makes them a ton of money. So the point is that whenever they impose a rule, healthcare will figure out a way around it. They'll figure out a different way to advertise. They'll just go advertise with influencers. They'll just get a bunch of women on TikTok to go, "Oh, I took Botox today, and look how great I look," right?
Okay. Although FYI, this executive order, if it is an executive order, does include influencers. It's
Yeah,
not
I know.
just TV.
I'm
But
just I'm
but but I get your
examples.
point, which is,
Yeah,
hey,
they'll figure it out. They'll figure out a way.
yeah. All right. So okay, here we go. Did you hear about the NASA announcement yesterday?
Is this like two men walk into a bar? No, is there a joke behind this? Or
There isn't. No, 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 there isn't. But yesterday was a crazy day for reasons we're going to talk about in the rant.
okay.
But they actually made a press announcement saying that we've found the strongest evidence to date of potential life on Mars, life off of Earth.
Wait.
And
Life on Mars or just life off Earth?
well, life on Mars, but that's life off Earth, right? So, but
Okay, so
life off Earth, but specifically on Mars.
so
So,
there's people that so they're saying that there's actually some living organism on Mars.
they're basically saying, and I don't have the article in front of me here, but
Okay.
that they found some microbial evidence that seems to be only possible through a biological process. And so NASA said, I was watching the news report yesterday. NASA said, look, we kind of didn't believe this, and so we gave it to a bunch of external scientists and said, look, you look at this and you tell us what you think. And I guess they've spent the past year studying it. And they've come back and they've said, hey, look, like biology seems the most likely answer to this question here. So it's not a definitive declaration yet. And I think they're saying to be definitive, they need this was taken by, I think, the Perseverance probe that's out there, or
Yes.
rover that's out there.
I'm reading as you're talking, I'm reading the
You're
article.
reading it, yeah. So I think they're saying we're not going to know for sure until we bring this back to Earth and study it in an Earth lab. But right now they're saying, hey, we might have just found life outside of Earth. Now, I
Just
really threw it in here. Go
yeah,
ahead.
just to be clear though, it's microscopic life. It's I don't
Oh
it's
yeah, it's
not
not little
little.
green men.
Yeah,
No.
yeah, it's not little green men. It's just there might have been bacteria at one time on Mars.
Right. And this
Yeah,
was this was in a former river or seabed where they
yeah.
hoped they might have the greatest probability of finding something like this. I really just put it in because of the whole gobsmack thing, Lance, which is
No,
just
I
like,
think it's great.
yeah.
I mean, I'm still focused on this whole Atlas, A1 or whatever it is, 3-1 that's hurling through, space. That's
That
supposed to
they think
be,
might be an alien probe. Yeah.
yeah, it might be an alien probe. So I'm more interested on that one.
Where the timing would be really interesting because not to get too off track and nerdy, but as I understand it, there's a equation for like life in the universe called the Drake equation.
Mhm.
And one of the inputs in it is the likelihood of life emerging, anywhere in the universe. And the universe is so massively big, it is a little hubristic to think that life could only, evolve on our one little planet. Um, but so that's a really key indicator, right? Which is what's the variable you put in there for the probability of life? If we end up confirming that there once was life on, the next planet over from Mars, I think you got to really bump up that probability factor of that variable of the potential for life in the universe. So that would be really interesting. The other thing that's interesting in that equation is, I guess they said the biggest factor in that equation is the length at which a sentient civilization persists. Like, you know, let's take humans. If we persist for, you know, billions of years from now, well, then the universe is probably teeming with life, right? If a sentient being can last that long. But if you end up kind of destroying yourself in one way, shape, or form, or your sun goes supernova or whatever, and it's measured in a much smaller period of time, let's say thousands of years, then we're probably alone in the universe right now. So it really depends on that length. So, anyways, kind of interesting that unknown object is coming here right now, Lance. At the same time, we find potential evidence of life on Mars, because if it was proven to be real evidence, then like yeah, the odds of that thing being like
Yeah.
an extraterrestrial probe probably go way up, because we would much more likely encounter an alien species through its technology first versus actually meeting little green men, right? Because of the limits of traveling at light speed and stuff like that. You do what we did with Voyager. You just send it out, and then maybe, hundreds of millennia later it passes
Yeah.
by, someone's planet.
Yeah. It's one of my favorite lines from a movie is from Contact with Jodie Foster. Did you ever
Yeah,
see
that
that
was
movie?
a really fun movie, great movie.
Yeah. And one of the lines in that movie that always really stuck with me is that, when you think about all the billions upon billions of stars that are out there that potentially have, billions and billions of planets surrounding those stars, if we're the only life form in all of that, it would be an awful waste of space.
Yeah, I love it. Awful waste of space. And I wonder, I should have looked this up beforehand, but how many stars are in our galaxy? It's probably billions, I think.
Yeah,
But type in if
absolutely.
you can. So billion, so that's a waste of space just in the Milky Way galaxy.
Yeah,
And then you realize the Milky Way galaxy is one of billions of galaxies that are out there, right? Yeah.
exactly. Yeah, I
Yeah.
mean, and it's just it's just one of those things. There are 100 to 400 billion stars just in the Milky Way
Just in
galaxy,
the Milky Way alone. Yeah. That's
and
just
each one of those
mind-boggling.
stars potentially has planets surrounding them.
Yeah. 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 Just okay. So, anyways, fun, not really related to the markets. Okay. Trades, Lance. Have you guys made many trades over the past week?
No, we're probably gonna do some next week. We're getting a couple of setups. One, we sold Apple previously just because revenue growth is really slowing for that company, and we talked about maybe swapping it for Meta. We're kind of getting a decent setup for Meta. We may pull that trigger next week on a starter position for that one. I'd love to see it pull back some more, so I can add to it.
I know you've been waiting to buy more
Yeah.
for a long time.
Yeah, yeah. So it's just one of those things, just trying to time a decent entry point, just being patient with that one. Outside, then the other side of that is really we're going to take profits and again, we're trying to rebalance some of these thematic models that have had just huge surges. We've got a couple of positions of small mid cap stocks as an example. They're up 50, 60% since August the 1st. It's just, they're way outside of their normal position sizes. So we're just going to trim those back to weight.
Okay. Okay. But basically doing the rebalancing
Yeah.
and then watching Meta closely to see if it gives you an
Yeah.
entry point.
Yeah. So we may do that next week, but yeah, no trades this week so far.
Okay. And I mean, all things continue to go pretty well, right? Good year
Yeah,
for
yeah,
RIA.
yeah.
Yeah.
Yeah, our portfolio just hit a new all-time high today. So it's, performance is doing well. It's tracking the market very closely this year, which it shouldn't be because of the bond weighting. And we have 12% cash in the equity model. So even though we have 12% cash and fixed income, it's actually tracking the benchmark, the S&P pretty closely this year. So knock on wood, so far performance has been really good.
So I saw a comment the other day that's really relevant to that point, Lance, which is someone said, "Hey, I heard Lance say that he was, tracking the market. So why don't I just own the market? Why not just own an S&P 500 fund?" And I think the answer is yeah, you could do that, but
Mhm.
Lance is doing it this year at a much lower risk profile,
Yep.
right? Yeah. And,
Yep.
returns are great right up until the risk part kicks in, right?
Yeah. And one of the reasons that we're tracking the market so closely this year is because when the markets were down 20% in April, we were down 4. So I don't have to have that rate of return out of the portfolio that when you spent time getting back but just owning the index, getting back to where we are now, I was already there ahead of you because we never had that drawdown to recover from.
Right. Right. And this all goes to folks why, it's so
Yeah.
important to really be clear on your goals and your risk tolerance and all that type of stuff.
Yeah,
Um,
absolutely.
but I think all things being equal, most folks would say, look, if I can get similar returns with less risk, why wouldn't I always take that? Right. And of course, there's no guarantees, folks. Lance is going to have some bad years, ahead of him.
Sure. Yeah.
Yeah.
Yeah. I mean, there's years we're going to underperform. And look, and you should not invest with us if you expect to track the market every year. If you're expecting to just track the index every year, then just go buy an S&P index fund, you'll track it. My goal is to get 80% of the upside in a given year. So if the market's up 10, I'll be up 8. But if the market's down 10% in a year, my goal is to be down 2. So we look to get 80% of the upside, 20% of the downside. And what that allows us to do over time is to generate a consistent rate of return in portfolios to meet financial goals. I could care less what the market does. My goal is to protect capital and grow it over time.
Okay, right. All right. Well, look, in wrapping up here, this is a tough one to keep concise, and I'm just going to try to force it to be concise. Um,
I'll give you a yes or no answer.
yeah. Well, I'll do my little part, and then I'll hand the baton to you. So, yesterday was quite a sad day. We had the assassination of a young political activist. I don't know the best way to describe Charlie Kirk. And I'm not going to talk about Charlie, very polarizing guy, a lot of supporters, a lot of people who really didn't like the things that he talked about. And the reason why I'm bringing it up here is when I saw that happen, it was one of those moments, sort of like an assassination of RFK or JFK, or one of those moments you're going to be you'll remember where you were and why it happened.
Yeah.
And the sadness the heaviness that I felt yesterday was really for the country, which was we're this is not who we are. We are better than this. And I'll talk in just a moment about the importance of free speech and the role it sort of played in all this. But as I was trying to get on top of my reaction to it, I began thinking, wow, like this whole concept of the fourth turning. If you understand that framework and you believe that we're in one, it is quickly becoming reality here versus an academic concept that we can bat around that's kind of interesting to talk about. And, in addition to the assassination yesterday, you look at the attempts on the president, during the campaign, the fact that we have, National Guard being deployed into our cities. We had the broad daylight assassination of the CEO of United Healthcare. We had the fire bombings of the Tesla dealerships. We've had a number of really racially charged murders being thrown around in the media of late. We've had a new rash of school shootings. I mean, Lance, I know you were alive, but you were real young. But this to me feels a lot like what the late 60s seemed to have been. And that wasn't even a fourth turning.
Right.
But my understanding is being alive that time, it really did feel like the world was in a very tenuous place of the country of potentially spinning out of control. Which kind of makes me shudder that if Neil Howe is right and the way that fourth turnings go and the fact that they kind of accelerate towards the end, makes me shudder at what future upheaval may be lying ahead of us here. So processing it as best I can, here's what I think. I think that what I hope we take away from this as a society and individuals is two kind of key messages. One is that we must do better. And I think we've gotten to a place here as a culture where for an increasing number of people, violence is being chosen as a valid response to ideas. That idea I don't like, it's challenging me. That's giving me the permission to actually use physical violence in response to that. And I think we need to just come back to our principles and say, no, that's not the way it should be. There's a reason why the First Amendment is the First Amendment. And we have been through times like this as a people, and we have pulled ourselves together eventually and just laid down the law like this. And we have to do that, I think. And we have to do it kind of collectively. All sides have to say, hey, look, we can really disagree and really dislike the thoughts that the people who disagree with me have. But we have to respect their ability to have those opinions. And we have to demand that of our leaders, like, hey, you got to get on top of this. And we have to demand it of ourselves in our own interactions with people. And I was kind of poor analogy, but I was sort of trying to talk this through with my wife yesterday. and was making the analogy of an oil. You ever seen an oil well on fire, Lance?
Yeah.
Yeah, it's like a blowtorch, right?
Yeah. I live
Um,
in Texas. Of course
you
I
live in
have.
Texas, exactly. Yeah, and it really surprised me when I learned that a pretty common way to put out oil wells that are burning, at least it used to be. I don't know if it's still used today, but it's dynamite.
Yep.
And I was like, God, that sounds like the worst idea ever.
Yep.
But what it
Red Adair was
does,
famous for that.
yeah, it when the dynamite explodes, it exhausts all the oxygen, basically in a sphere around the well. And when it does that, the flames go out, right? And then you just have a gusher of oil, and they know how to tap that thing off, right? And I think as a society that we really need to look at doing that, which is just to say, hey, look, this is something, we're going to have just a zero tolerance for. We just got to, starve it of its oxygen, just not allow this to happen when it can. So,
Which is exactly what conservatives have been trying to do now for a
let's
while.
not make just help me. I
Well,
don't
no,
want to make this
I'm just saying
partisan.
this is what you're talking about is exactly the whole kind of what's led us up to this point is that we had this whole very fringe side that was, spewing a lot of hate online and doing all that. And you're just going to generate this type of environment when that occurs. And
Well,
again,
yeah,
this is just the consequences of what we did over the last 4 or 5 years of allowing that to happen.
I agree. And I really want to try to not make this partisan. And
Well,
I know
it's
everybody
not
has their,
partisan. It's just facts.
no, it's facts. But yes, to the extent I'm trying to walk a tightrope here because I know I'm talking to people who have very different opinions on both sides about all this. I'm trying to
Yeah.
find things that we can find common ground. And I agree. When you demonize the other side, you make it a lot easier for somebody, law of large numbers, right?
Mhm.
You say that person is evil,
Right.
right? If half the country thinks the way that you do, law of large numbers, there's this small kind of unbalanced fringe that says, oh, well, look, I'll be a good person if I go kill that evil person, right?
Right.
So,
And what we see repeatedly is with all of these people, when we get them, there's mental instability. There's some other mental, some other problem in the background that's always fostered to this point. But again, what your point you're making and what you're right is that we've got to go back to our core principles and our core principles of being good people and having freedom of speech and being able to discuss ideas and all these things that used to be the case. I used to do political talk for 10 years and I quit doing political talk because you could not have a discussion with somebody about politics any longer because it just immediately you would present the facts and they would have immediately just start screaming and yelling and just pointing fingers and calling you names and all these type of stuff. And it's like we can't even have a conversation about politics on a rational basis. It's okay for you to disagree with me, just like you can disagree with me on stocks or bonds or whatever. It's okay to disagree. Just bring facts. And we write articles every week. Here's, this is what's going on in the markets. Here's all the data that backs up our analysis. You can argue with that as long as you can bring substantive data to discount those facts. But we've stopped doing that over the last really 15 years. And we just started yelling and screaming at each other. And you go on, and then we started blocking people online because we didn't like what their view was. And if we didn't agree with their outlook, we just called them evil or mean or whatever, started calling people Nazis for no reason. You just got to go back to some level of sanity and say, can we have a rational discussion? It's okay for you to disagree with me. And this was the one thing about Charlie Kirk. He just presented facts. He openly debated people. He gave people an open forum. Hey, come debate me. And college kids would show up and they would say, "This is my opinion," and he would say, "Well, here's the facts." And he would just present facts. He didn't demonize them. He didn't argue with them. He just presented the facts of the argument and let them really kind of back themselves into their own corner in most cases because they didn't have the facts to back up the argument. They were told these things that weren't true and they believed them, viciously, but they didn't have any facts to back up that data. He had all the facts and the data that he argued with, and people didn't like that. But that's okay. That's what this whole country was founded on, was the ability to have these discussions, to have freedom of speech, to talk to each other as human beings and say, it's okay. Look, I have family members. My cousin Dwayne, who lives in Utah, as liberal as he can be. We disagree on virtually everything, but he's one of my best friends. And we have conversations, we talk, we have, we laugh, we joke with each other, we argue with each other over certain topics. I present my case, he presents his case. He's always wrong, but you know, but
Yeah.
we're great friends. We can have that conversation. Why can't we have that with everybody?
So I agree with everything you're saying. This is why I'm a huge fan of national service. Would be just if not only do I think it's a good thing for the
Yeah.
country and it's a good thing for us just character-wise, but because it would get us working and living closely for at least, some part of our lives with people from all stripes, all different backgrounds, and we would learn that, hey, despite the differences of opinion, we all very much share, in many cases, the same values. And,
And we learn from differences of opinion.
absolutely. And we talk about, diversity being a strength. Well, yeah, I mean, like one of the key things about being a critical thinker is having your thought process challenged by other forms of thinking and then determining over time what you think is the best.
Which again, look, you and I disagree on a lot of stuff, but that's always one of the things I've always valued about our relationship is that you present these ideas, then I go write an article proving you're wrong, but it makes me go work and do the analysis to prove that. And so I learn, I'm just teasing you.
I know, I know.
But it does, you present these ideas. I go, that's a great idea. Let me go dig into that. And then I have to go pull all that data and to build the charts and build the graphs. And it teaches me about, these various aspects. And if we would spend more time doing that as people, we'd be in a lot better position.
Well, and that's one of the things that made me so sad about yesterday was that, you know, Charlie Kirk, and again, I'm not here to tell you whether he was a great guy or not great guy, but he was doing what we need more of, right? Which is open debate, right? Which is, hey, we all don't think the same, let's talk it out. I don't know a ton about him, but I know that at his college appearances, he would say, "Look, and if you disagree with me, please come to the front of the line. I don't want to be talking to people who agree with me and everything. I want us to try to collectively try to hash out what we think the truth is, so that we can both learn from this, right?" And uh, the fact that sadly, I think it's going to place a chilling effect on this kind of open discourse and learning with each other for a period of time. And that's what I'm saying is like our reaction to that has to be kind of allergic, like, no, we're not going to let that happen. In fact, we're going to do more of this going forward. So,
Yeah.
um,
Well,
you know,
I'll say it. I thought he was an amazing individual. This kid was 31 years old, never graduated college, built this entire business, American Turning Point, on his own, had a beautiful wife, two kids, great family guy. But what amazed me about him is that he had an amazing ability to tap facts. He was very well read, very understood. He understood I mean, you could ask him a question on virtually anything, whether it was philosophy or politics or religion, and he could quote you scripture from the Bible, from the Quran to Buddhist. It was amazing how much knowledge that young gentleman had at 31 years of age, and
all right.
not to have a college degree. He was just absolutely a phenomenal individual, very, very smart, and just as a human being, it's a tragic loss of life.
All right. And again, whatever your position is of him, I think we can all agree that, killing a young father, for his views is a something that hopefully we can all agree as a society is not acceptable. That is not something that we want here, that's a tragedy, and that we should do everything we can to try to not have that be repeated in the future.
Yeah.
So here's where I'm going with all this, which is, look, this ties together a whole bunch of dots that I feel like have been building, and a big one was the interview I did with Greg Lukianoff, The Coddling of the American Mind, which is, when you overprotect uh, your people from adversity in life and challenges, they don't develop the mature mindset that says, okay, you know what, these things aren't existential threats to me. And I can learn that people have different ideas, and I can be challenged, and I can still, come out okay with that. And I can determine, I can self-determine and all that type of stuff. Much later in life, you're still reacting to this stuff as if it's a physical threat to you. That's why we've talked about college campuses, right? The demands for safe spaces and the cancel culture. And that professor said something I didn't agree with. He's got to be fired, right? All that type of stuff. I think we're starting to kind of feast on the banquet of consequences from all of that here. And look, I get it. There's a lot of people hurting in this country in a lot of different ways. It's also still, in my opinion, best country in the world and lots of opportunity here for people. Um, but at the base level, Lance, desperate people act desperately, and
Mhm.
so I don't want to ignore the fact that there isn't a lot of work that we can still do among society. And so, look, this is a big reason actually why I created Thoughtful Money, which was if I can help more people feel less financially desperate, maybe even help them get to a state of financial prosperity, like that's a force for good in the world. That starts lessening the pressures that people feel and feeling like they have to lash out or do something really, really desperate out there. Now, is thoughtful money by itself going to solve all the problems in the world? No, 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 not at all. But my point is like when I talk about how we need to step up and say, look, we just can't accept this. Like that's I'm going to make two commitments here. That's my first commitment, which is, I'll keep doing this for as long as, I'm able to, and folks are willing to watch this channel. Um, you know, I feel like that's a role that I can play at a mass scale, right? Which is I can try to help more people get onto a better financial track and give them more opportunities in life, and they will hopefully feel less suffering and less desperation to go do something really kind of batshit crazy like we just saw yesterday. Um, Secondly, and so my ask to all of you would be to say like, hey, what role can you play? What could you possibly do here? And not all of us can act on a more mass level. On a personal level, I was feeling really frustrated yesterday. Again, just about this and how it was making me feel about the direction of the country. And so I was trying to think, well, what can I do? And I was reflecting on this quote, Charles Mackay, the guy that wrote the book, The Extraordinary Popular Delusions and the Madness of Crowds. He had a great quote in there, and he said, Men, it has been well said, think in herds. It will be seen that they go mad in herds, while they only recover their senses slowly, one by one. Right? And I think at a time like this, where the herd is kind of going crazy, um, we have to remember that the way that in which we're going to get through this is to try to help people one by one kind of get to a better place, and then collectively we can carry ourselves to a better place. So I initially wasn't going to share this because I don't like to kind of make a commitment before I've actually done it. I don't like to make a promise. I like to actually do it and then tell you I've done it. But I was trying to think, okay, so what role can I play on an individual level that could help out here, as no matter how small it might be. And as folks know, I just recently moved to Nevada. So I decided, well, why don't I just, I've got my own kids. Honestly, I don't feel like I give them enough time given all the work, my crazy work schedule and stuff. But I basically said, look, why don't one thing I can do is I can try to make the difference in the life of one less fortunate person out there. And so I reached out to the Big Brothers Big Sisters organization of Northern Nevada and filled out an application, and hopefully we'll be matched with some deserving kid from a underprivileged background, and try to make a difference at least in one person's life going forward. And then collectively, if that inspires more people to go do something similar, and I don't mean go work with the same organization, but I mean just look in your community and say, hey, what might be I be able to do to kind of help build common ground, help make things just a little bit better, especially for those who are maybe under pressure. That may be our part of collectively helping the herd regain its senses one by one from here, and hopefully avoiding, when it gets dark at night and I really have fears about where the fourth turning could go, hopefully avoiding those types of outcomes. So anyways, Lance, that's my rant for the day.
No, I think that's great, and I've done Big Brothers Big Sisters before, and I think that's an awesome organization. In fact, I haven't done it in a long time, but now that my kids are out of the house, maybe that would be something to look back into as well.
Well, I mean, that's right. When we're empty nesters, we got a little bit more bandwidth,
Yeah,
right?
yeah. So yeah, I think that's great.
Yeah. All right. Well, look, we'll end it there. And we've had some pretty heavy rants recently. It hasn't been planned, and I sure wish we didn't have the reasons for, why we picked this one for today. Hopefully we get to some lighter ones going forward, Lance.
Sure.
You know, again, for turning wise folks, if you're not familiar what I mean by that term, go check out the interviews I've done with Neil Howe. It's a I think it's a very important framework, especially for the time we're living in. And I'll have Neil back on again relatively soon, folks. So I'm sure, he's got a lot to say about, sort of the
Always.
acceleration of all these crazy developments that I've just talked about. But the most important thing is that we get through it all together. And hopefully, thoughtful money will be one of the ways in which, those of us who collectively participate in these videos can try to get through it all with each other's support. All right, with that being said, if you think the best way to regain any sanity you've been losing is to continue to watch Lance Roberts on this channel week in and week out from here on in, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like to get some help from a professional financial advisor in trying to figure out how to navigate your wealth through the road ahead, especially if it follows the course that Lance has outlined for us here that he thinks might be the likeliest path, highly recommend that most people watching this video get that help from a good professional financial advisor, but particularly one that understands and takes into account the macro issues that we talk about on this channel. If you've got a good one who's doing that for you, great, stick with them. If not, then consider talking to one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you might even want to talk to Lance and his team there at RIA. So to reach out to them, just fill out the very short form at thoughtfulmoney.com, and the firms will be in touch with you quickly thereafter. Lastly, just a reminder that Thoughtful Money's Fall Online Conference is coming up fast. It's just a little over a month away at this point, Saturday, October 18th. Don't worry if you can't watch live. Everybody who registers will get sent a replay video of the entire event, all the presentations, all the live Q&As. We are still offering it at the low early bird price discount, the lowest discount we're able to offer for this conference. So I want to make sure as many people get that lowest price as possible. So if you haven't bought your ticket yet, go to thoughtfulmoney.com/conference and buy it now. And if you are a premium subscriber to our Substack, don't forget to check out your email inbox. Look for the code I've sent you that you can use to get an additional $50 off of that conference. The faculty continues to come along just great. It looks like it's going to be our best faculty ever. And from a timeliness standpoint, seems like it's going to be the most timely one we've ever done. All right, Lance, as usual, my friend, so great seeing you, talking with you.
Yep.
Real quick, I hope everything's going as best can be hoped at home for you.
Yeah. And so, by the way, we forgot to tell people that we recorded this on Thursday. Rather
Oh, you're right. We totally forgot that. I'm sorry. I should
Yeah.
have said at the beginning. Yeah.
Yeah, and that's because tomorrow is my wife's first chemo treatment, so we're gonna go. We've got to go a lot of prep work today. But the big journey starts tomorrow. So, but that's why we were a day early, and so some of the data is still filtering through for this week, and so we'll catch up next Friday and get up to date on everything.
Okay. Well, look, best of wishes for you and especially for your wife going through that, Lance. And while I'm sure it's a journey you'd rather not be on, it's great to hear that she is getting the swift help that she needs.
Yeah. Oh no, we just have been overwhelmed by the number of thoughts and prayers and wishes from your viewers, people that follow me as well. We've just been completely overwhelmed with that, and that's been fantastic. But look, we're very optimistic. We believe in our faith, and we're walking our faith, and we believe that the outcome of this will be what it needs to be. And so we're just taking this one day at a time.
All right. Well, lots of love, support, and prayers from everybody here, Lance. And yeah, go do everything you need to do. We'll see you next week when you come back. If you got to attend other things as well, don't worry. We'll get Mike or some other one to fill in.
Yeah, no,
But
we're
yeah.
good. So, well, no,
All right.
I'll definitely be here next Friday.
All right. But we're all behind you guys 1,000%. All
Appreciate
right.
it.
All right. And with that, everybody else, thanks so much for watching.
I have 4,000 on gold. I can't remember whether when we talked last time I was there, I had been at 3,400 and raised it sometime in last year. So I raised it to 4,000, and I think we've been consolidating since April in a sideways consolidation. we're very close to breaking out of that, and I think we're about to. I think we'll see it in September, and have another nice run, probably to 4,000 in the last 4 months of the year. Silver, I have a 75 target that I've had for a long time. I think gold can get to 20,000 by the early 2030s. And I say early 2030s. That does not mean 2030. It means could be 2032 or 3. I don't know.
Yeah.
But 20,000 for gold and 500 for silver.
Gold recently hit a record high of around $3,526 per ounce, buoyed by a weaker US dollar, inflation fears, and declining confidence in treasuries. Analysts from Goldman Sachs and Morgan expect gold to reach $4,000 by mid-2026. However, silver is the standout performer of 2025, up around 40 to 42% year-to-date. Optimism is growing that it may finally break a multi-year underperformance trend relative to gold. For silver, the near-term target is $75. While the long-term targets of $20,000 for gold and $500 for silver remain highly speculative, current trends and expert forecasts suggest gold may approach $4,000 in the near future, and silver could begin to make significant upward moves. The speaker, David Hunter, a famous personality in precious metals, believes Wall Street has been too skeptical of this rally, while retail investors have fared better. Strong corporate earnings, driven partly by AI, and an underlying weak economy point to lower interest rates ahead. He expects the 10-year yield could fall to 3% by year-end and eventually to 0% as his global recession or global bust unfolds. Contrary to the mainstream view, he sees both short and long-term rates moving down, supporting bonds and even corporate credit in the near term. Hunter views this as the final stage of a 43-year secular bull market that began in 1982. With the Dow then at 780 and potentially reaching 60,000 soon. Falling rates, strong earnings, and a weaker dollar could fuel a parabolic move higher as institutional investors finally capitulate and turn fully bullish. In Hunter's view, this capitulation will provide the momentum for a steep final run in the equities. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
I think what we're going to see, and it's starting to happen, as I've said for a long time, from basically 2022 up, from October 2022 bottom down at 3,500 on the S&P, and I don't remember where the Dow was, but from that point forward up until very recently, and even now, most of Wall Street was skeptical. Retail did better in April. They didn't fall for the head fake, and they stayed bullish and they bought generally. So a lot of retail got scared, but generally the retail did better. Institutions got bearish, and they've been skeptical of this market all the way up. They keep looking at valuations and thinking valuations are at peak levels and they can't go much higher, and et cetera. What we're seeing is obviously because of AI, but also other things, the companies have done a great job in an environment that wasn't that easy to keep pushing the earnings higher. And, I saw that. That was part of my thesis. I also think people are way too bearish on the bond market, on interest rates. And I think, in fact, I'm very bullish on bonds and think rates are going to go a lot lower. And that's different from, I think, the street. But ultimately, I do think the U.S.'s rates are headed lower, both on the short end and the long end. I am very much and have been consistently saying, though today's GDP, for example, came out with a revision upward, 3.3% on GDP for the second quarter, I still believe under the surface, we have an economy that's not doing that great. And we have an economy that's heading for recession. So that has kept me bullish on bonds. I'm not so worried about exactly when it turns or how much it turns initially or whatever. I do think you're going to see the 10-year go to 3%, maybe by the end of this year. It doesn't have to be by the end of this year, but maybe. And ultimately, next year is going to be a rough economy, in my opinion. I call it a global bust. And in that, I think you can see the 10-year all the way down to zero. So I'm contrary to say the least. But I am not in the camp. I know there are a lot of people that look at last fall and say, oh, the Fed can lower rates, can cut rates, but the long end's going to go up. And I know that's a big story around Wall Street. I don't believe that at all. I think you've seen, basically, I'm more focused on the 10-year because that's what loans get priced off of, mortgages get priced off of. But even the 30-year will ultimately fall. It may be stickier to come down initially, but ultimately, I think all rates across the curve are going to come down. And even the corporate bond market for at least a little while longer is going to do okay. That we're in the end game of a 43-year secular bull market. At one time, I thought it was going to be a 42-year, and it stretched out. But it started in August of 1982. And the Dow at that time was, I can remember because I was running money then, and I turned bullish in August of 1982 in a new place where I basically had a great run. And they fought me. They were not equity guys. They thought we were crazy to do what we did, but I had top percentile numbers for 5 years running. The Dow back then was 780, wow. 780. And I'm calling 60,000 for this year. And frankly, I get beat up, as you know, all the time about moving my time targets. I don't have a time target per se. I do. I'm not saying it can happen anytime, but whether it happens in October or November, December or January, I don't care. It's coming soon. And people say, "Oh, you've already pushed it out again." No, I haven't. I haven't changed anything. I still think it could happen, by October or November. But anyway, it's rates coming down and earnings going up, still holding firm. And very big part of this, and the dollar selling off, and a very big part of this is Wall Street moving from constantly looking for a top with one foot out the door to being all in. They're getting closer to capitulating here and saying, yeah, I got to get more bullish because this thing has legs. And that's going to be the fuel for what I think will be a very steep run. But in answer to your question of how you could go that far, that fast, it's a parabolic that I think comes at the end of such a long cycle.
David Hunter recalls his success in 1982 and draws a parallel to today, noting that when the Fed eases, bonds, equities, and metals typically all rise. Hunter expects a similar setup in the coming months but warns this cycle is unusual since it didn't start from a bear market trough. While many have fought the rally, Hunter believes the eventual top will come when everyone is fully bullish, at which point he'll turn contrarian, and quadrillions in derivatives turn a normal downturn into a severe global bust. On commodities, Hunter has been bearish on oil since 2022 and sees it possibly falling to $30 during the bust but then soaring to $500 by the early 2030s. Hunter argues massive money printing, $20 trillion in the US and up to $50 trillion globally, will drive huge demand for commodities to build new infrastructure, while supply growth remains constrained for years. This mismatch, Hunter says, ensures explosive price increases once demand outstrips limited supply.
I guess I cut my teeth in this. Like I said, my favorite time to remember was 1982 because I hit it right on a dime and had really top 1 percentile pension fund manager performance for 5 years running in a shop that I had to drag along kicking and screaming. So I remember that very well. It's also reminiscent of what you get at when you have the start of a Fed easing cycle, right? So when the Fed starts printing, what moves? Rates move down, so bond moves up, equities move up, and metals move up. And so that's what it's going to feel like, I think, in the next 3 or 4 months. The thing is, we're not starting from a trough.
Sure.
We didn't go through a bear market. So that's what's unusual. And I think that's where people are going to probably get it wrong is they fought this all the way up. I keep saying that at the top, what you'll see is everybody will be all in and tell you this thing has years to run, at least a couple of years to run. And I'll be at that point contrary and saying, no, this is the top, we're close to the top. And I think we will actually see CPI negative, PPI negative, even PCE negative. And it comes, my reasoning is pretty simple. It's number one, we're highly leveraged. The reason I call for a global bust is because we're so far beyond even 2008-9 in terms of leverage on the system, both debt, as I keep quoting, 330 trillion in global debt, and I realize a lot of it's sovereign, but 330 trillion in global debt, and quadrillions in notional value of derivatives. Never been here before. Never. And derivatives are leverage on markets. Debt is leverage on the system. Never been here before. I mean, this is so far beyond anything we've charted in our past. That'll turn a normal downturn into something far worse, I think. And so, and obviously a financial crisis if leverage starts unwinding. So that's how I get to a global bust. I de-bear on oil since 2022, and correctly so. I turned bearish on oil before we had the spike up during the Russian invasion of Ukraine, but I stayed with it at 130 and said we're going back to 85. And then once we broke 100, I said we're going to 60. So I've been pretty bearish on oil. I think we see probably 30 in the bust. And then from there, and it could certainly go lower given what happened last cycle, if you remember when it went to negative.
Who knew?
But I'll say 30. And from there, I think you could see $500 oil by the early 2030s.
Wow.
So again, as I say, it's a commodity cycle. Copper could be 20 or more. It could fall to $1 or $2 in the bust, but go from there to 20. Natural gas might be $50. I mean, I don't know where these things are going to go. What we're going to have is massive demand for commodities because they're going to be needed for building new plants and equipment and all that. Because of that 20 trillion print and probably 50 trillion worldwide, it's gonna goose demand, and we've rationalized down supply. The mining and all that, and search for oil, etc. We've rationalized that all down in a period when they were trying to discourage all of that. So if we get that through the roof, like I said, the demand because of the money print can happen within 1, 2, 3 years, whereas the having to build new supply can take 10 or 20 years. So you're going to have a case where you have supply far exceeding demand, and the only thing that can give is price.
David Hunter envisions an extraordinary but volatile path ahead. First, a deflationary global bust, then an unprecedented boom fueled by massive money printing, collapsing interest rates, and surging demand for commodities. While his bold forecasts for gold, silver, equities, and energy markets remain controversial, they highlight the risks of extreme leverage and the potential for historic shifts in global markets. Do you think Hunter's prediction of a global bust, followed by explosive commodity inflation, is realistic or overly extreme? If gold and silver do reach his long-term targets, how might this reshape global financial markets and currencies? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.
We are at the end of a major monetary era, and this one is so big that it's going to end, sadly, a catastrophe for the world. This is why we went into gold investments for ourselves and for our clients at the beginning of this century, and we never changed our mind, and we're, as you know, only in physical gold and helping people around the world.
The way that Modi, who had been playing a two-step dance with Trump and with Russia and China, has now gone into a quick step right into the hands of Putin and Xi.
But isn't that telling us that, this is the end for the West, the end for the United States? Obviously, the EU will follow also.
What will emerge is that China is going to stand firm on tariff and trade issues.
We are at the end of a major monetary era that will end in global catastrophe, which is why they've stayed invested only in physical gold since the early 2000s. At the recent SCO summit, warmer ties between Modi, Xi, and Putin signaled India's shift toward balancing U.S. pressure, especially after friction over Russian oil tariffs. Analysts warn that U.S. deficits, trade wars, and eroding trust in the dollar could make capital controls increasingly plausible, with scope even warning of a potential U.S. downgrade. While there's little hard evidence of large-scale U.S. capital flight into Switzerland or gold, uncertainty is fueling concern that the dollar-centered monetary order is weakening as a multipolar world emerges. Key risks ahead include potential U.S. regulatory moves on capital flows, further rating downgrades, and rising demand for safe haven assets like gold as geopolitical and financial pressures intensify. The speaker, Egon Von, the founder of Matterhorn Asset Management in Switzerland, in a crosstalk with Simon Hunt, is an independent strategist and consultant, warns that capital controls are coming to the U.S., with the dollar and financial system under attack. There are signs that confidence in the dollar is weakening. Investors are reacting to U.S. trade's tariff policies, rising debt, and political uncertainty, which in turn is leading to discussions about de-dollarization, diversification, and concern about the dollar's future role as the world's reserve currency. Figures like Robert Kiyosaki are warning of a looming central bank crisis. Egon and Simon suggest investing in gold, silver, and even Bitcoin, though often with caveats, as hedges against fiat collapse. Elevated inflation and weak growth plus geopolitical tensions are pushing institutional and private investors towards inflation hedges: gold, silver, real assets. Some analyses point out that usual safe assets, bonds, cash, may offer lower protection in this environment. Egon warns today's risks include banking crises, collapsing currencies, and rising social unrest, especially in the US. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I'm absolutely convinced that we will have capital. There will be capital controls in the US also. Dollar will be under attack. The financial system will be under attack. People want to transfer money out of dollars now are actually doing it now already. And we're seeing it. Americans reports about, especially the big banks in America, looking after wealthy families and individuals, that they're transferring a lot of money into Switzerland and also into gold, of course. There are not many places to flee to, are there?
No.
You got where you are in Uruguay.
Yeah.
Sorry, in Dubai, I mean. Uruguay is another one. From my point of view, I think Dubai is obviously fantastic now, but, it is next to the Strait of Hormuz. It can't be nearer than it is. It's so near. And, there has always throughout history and even throughout my lifetime been major conflicts in the Middle East. And, of course, then Dubai will be exposed also. For quite a while, part of my long-term forecast, I clearly saw at the end of the 90s already, and this is why I decided that we need to protect ourselves. You never know when it's going to happen exactly, and that's why we said, this is going to come. The end of a monetary era is coming. That's absolutely clear in my mind. Of course, we will have ups and downs. We will have stock market bubbles. We will have crashes. But, one thing I've learned, that to forecast price is a mug's game, and it serves very little purpose.
Equities is even a bigger mug's game.
Yeah. And therefore, what I'm more interested is in risk and in direction of the economy and therefore of markets also. And to me, already from the end of the 90s, I decided that the risk is absolutely at a maximum already, and it's going to accelerate and get worse. And therefore, you needed protection. And protection, of course, my point of view was there's only one asset that has survived throughout history and maintained its value, and that's nature's money, which is gold. All other currencies, as we know, have gone to zero. It's so easy. If you want to protect your assets, your old nature's money, and you know that at least, as it has been the case for thousands of years, you maintain your purchasing power. You might not always make a lot of money, but now when we've entered an era where governments are accelerating the money printing because the deficits is also accelerating, and now it's such an easy decision. I think this is the easiest investment decision I've made in my life. So, we recommended up to 50% in gold 25 years ago. And now I would recommend 100%, or we recommend maybe 25, 30% in silver. It's obviously putting all your eggs in one basket. But, it's like Rockefeller said, put all your eggs in one basket and look after the basket. and
I can't remember the name of the old Italian family, but there was a story of how they retained their wealth going back centuries. When wars came, they left with their gold and their art. They had title to the lands, and when the wars ended, they came back and they retained their wealth.
Yes, I think we are in that era now. Of course, everybody isn't wealthy and has art. Or in Venezuela, let's say, 25 years ago, if they bought gold then, the dollar was about par with the Venezuelan bolivar. Now, of course, currency is destroyed, the country is destroyed. And if they bought just a little fraction of an ounce of gold in those days, I mean, they would have saved them later. And the same today. People don't need to buy kilos or tons of silver or gold. They can just buy a small ounce, because I see now, I mean, this is going to accelerate. Currencies have gone down by 99% in real terms, in gold terms, since 71. It's just 1% to go. But that 1% is 100% from now. And that we are going to experience in the next few years, in my view. How fast it goes, it doesn't matter, really. Protection is more important than, as I said, forecasting the timing. You were talking about cycles of markets going up for a while and then going down. Yes, you're obviously into shorter cycles. In my world, we don't worry about that. We worry about protecting the risk that you have today. And there are so many black swans hanging above us. US banking system, for example. Civil unrest in America. We haven't talked about America. We talk about Europe. It's the same in America. I see civil unrest in a major way in America. It's already there. People are helping themselves, for example, taking or stealing any goods they want in shops. It's not just in America, happening in the UK also. Just walking in, hundreds of people walking into a shop, filling the bag, and they can steal up to whatever it is, $1,000. That's not a crime. And we are already into lawless society, and America will be very high on that scale of lawlessness, in my view.
Egon and Simon argue we are nearing the end of the monetary era, with the dollar, euro, and pound all in a race to the bottom. Forecasting gold in collapsing currencies is meaningless, only weight matters. The U.S. banking and financial system, built on endless debt and self-financed deficits, cannot survive, and capital controls are likely both in Europe and the U.S. safe havens like Switzerland. Dubai may offer some protection, but risks are everywhere. The bigger picture is the clash between the old US-led unipolar order and the rising multipolar world. This transition could end in war, or in financial collapse triggering political and military breakdowns, likely around 2028. The only real safeguard, they stress, is holding physical gold and silver as protection rather than speculation. Now let's dive into the interview.
Trump is moving the reservists into Washington,
Yes.
Chicago, etc., etc.
You talk about capital controls in Europe. I see exactly the same in the US. From my point of view, it's a waste of time trying to forecast which currency reaches the bottom first. There's no...
It's a race to the bottom.
Yeah, exactly. And there's no prize for being the first. They'll all be there, the dollar, the euro, the pound, etc. As we said, they're already 99% on the way. So it's not far to go. But that will happen too. And that will be the end of this monetary era, the way that I look at the world. And that's why protection is more...
I'm in complete agreement. Technical Associate has the dollar index, the DXY, halving by the end of 2028.
Yeah.
DXY is now about 97. We have it at 50 in 2028. What does that mean to the gold price?
Yes, and you get to the point, Simon, and I've been saying that for quite a while, that, it serves no purpose to measure the gold price in collapsing currencies because it's meaningless. You might as well measure it in chickens or cows or something more useful. I mean, gold and silver should only be measured by weight, really. How many kilos or how many ounces do you own? That's the only thing that counts. You know that you will maintain purchasing power. And if it will be $1 billion for an ounce of gold in a few years' time or $1 million or whatever, it's totally irrelevant because what's the value of the dollar at the time? And that's why, as I said, I gave up forecasting the gold price many years ago because it is a mug's game, and to forecast it in something that is sinking by the day serves no purpose. I mean, I see the US banking system, it's not going to survive in its present form, and nor is the European one, of course. So keeping money in the bank, I wouldn't recommend anyone to hold any money except for short-term spending money. If you have gold or silver, it's total liquidity. You can sell a gram an ounce whenever you want, and there's always a price for it. There's always a price. Yes, you talk about capital controls in Europe, but when I see clearly that the same is going to happen in the US.
I agree completely.
So where do people go? That's what they ask, of course. They don't want to be in the EU. I mean, Switzerland always has been a better and a stronger economy than the rest of Europe. Of course, Switzerland is under pressure from the EU. I mean, to the EU net, comply with more of the laws and the rules of Switzerland, is withstanding it. And of course, as Switzerland sees the EU collapsing, I sincerely hope and I believe that the Switzerland will definitely stay outside of the EU network. Whether Switzerland will be a bastion of safety and economic insurance in the future, I think it will, because it's a sounder people and sounder economy than most countries. But otherwise, go to Dubai, as you have done. And of course, it works very well for a lot of people right now. Uruguay is another country. Again, you're in the middle of a poor South America. You have Brazil and Argentina next to you. And when the bad times hit there, I mean, they are going to go to the rich countries like Uruguay.
Sure, yeah.
So that's a risk too. So you have a risk today that unprecedented. Of course, maybe the safest is to go to Russia or to China. But for Westerners, that doesn't feel right. US debt's never going to be repaid. And when you have a financial system with the dollar as the reserve currency, being in a country which is issuing massive amounts of federal debt on a daily basis, and there's no buyer of it except for the central bank itself, you're at the end. You know that if you both issue the debt and you buy your own debt, that is the
finished. Yeah.
ultimate of Ponzi schemes, isn't it?
Yeah. There's the question how all of this is going to end. Come back to where I started, that the real big picture is between the existing unilateral world that has operated for 80 odd years and the evolving multilateral world. It can only end in one of two ways. Either that the unilateral world, i.e. America, accepts that we are evolving into a multilateral world and therefore joins it. That's, under current conditions, is highly unlikely. Only other option is it's going to be war.
Isn't there a third option? America doesn't have to accept the dollar-based system and the reserve currency. It collapses. The financial system in the US collapses. The banking system collapses. Whatever desperate action they take with the whole Trump family now going into Bitcoin or cryptocurrencies and believe that that's going to be the savior of everything. That's not going to happen. In my view, cryptocurrencies are a bubble too, highly leveraged. And therefore, isn't there that third risk? I think that's a major risk, that it's actually led by the financial system collapsing in the West, probably in the US first, but it could be France or the UK starting. It doesn't matter why the trigger comes. Isn't that a very high risk to this system also?
Yes, it is. But the multilateral world and the unilateral world is not just a financial one, it's a political one too. And that's why I think there are only the two big options. Now, you actually given the trigger as to how this war between the two types of world will end by saying, rightly so, that the US and the Western system, financial system, is going to collapse. And in that collapse, you will then have political collapse.
And military collapse.
Everything collapse. And on my cycle timing, that is around 2028. That's only, where are we now, 3 years away.
That's like tomorrow. It's so intellectually so exciting to be in this era now, because, to discuss these matters and to try to not forecast exactly, but at least protect yourself and help investors around the world to protect themselves. And obviously with that comes helping family and friends and all of that. I see that as a major task of ours, and for people who are privileged that we are, because whether it's 25 or 28 or 29, it doesn't really matter. The risk is here and now.
If the US imposes capital controls, what options will remain for investors seeking to protect their assets? Could gold and silver alone provide enough protection in a scenario of systemic collapse, or should investors also diversify into other real assets? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
If bonds are getting inflated, if real estate is getting inflated, in the CPI, the CPI, they decided that you don't actually own your home, you rent from yourself. So it's a rental equivalent of what it's insane is what the CP lie is. But this sort of corroborates what I was saying, that the truth lies somewhere in the middle. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. The M2 is probably, and it ended up right in the middle. And so, yeah. So $1,000 silver is possible. I doubt it, but triple digits, I think that's a slam dunk, like I've said many times. And so silver is incredibly undervalued right now.
Recent analysis suggests that gold could reach $12,000 per ounce, mirroring the speculative surge seen in 1980. However, such a scenario requires a significant global crisis or a major shift in monetary policy. Currently, gold is trading at approximately $3,500 per ounce, indicating a substantial gap to this projected high. As for silver, while reaching $1,000 per ounce appears highly improbable, the metal is considered undervalued. Factors such as increasing industrial demand, particularly in electronics and renewable energy sectors, along with a widening gold-to-silver ratio, suggest potential for price appreciation. Mike Maloney, a well-known precious metals expert, author, and economic educator, highlights that gold has historically preserved purchasing power, but it also experiences bubbles, something it's not in yet. Compared to past decades, gold now buys far more stocks and real estate. Both gold and silver remain undervalued, with silver especially lagging behind even inflation-adjusted levels. Gold's popularity has rebounded to 23%, still below its 2011 peak of 34% after the 2008 crisis. Unlike 2011, today's volatility stems from policy and market factors rather than systemic threats. The World Gold Council reports that central banks purchased a record 1,037 tons of gold in 2024, continuing a multi-year trend of official sector buying. Silver prices in 2025 are expected to follow a steady upward trend, with a notable acceleration in the fourth quarter, during which December could see highs of $42.44. This growth may be driven by increased industrial demand amid global energy transitions and supply chain constraints. Investors are likely to view silver as a strategic hedge, particularly in light of ongoing geopolitical uncertainty and persistent inflationary pressures. Both gold and silver are experiencing notable market dynamics, influenced by macroeconomic factors and investor sentiment. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
Well, yeah, he's the great hedge to maintain purchasing power is true over the centuries, but there are times when it goes into bubbles, and it's not in a bubble yet. If you want to increase, if it were true that it has only kept up with inflation, then right now, the Dow Gold is at like 12 to 1, and it was 45 in 1999, 2000. I believe it was like 38 when I first started investing. So I can buy like 3 times more stocks with my gold. I can buy a whole lot more real estate with my gold and silver than I could back then. So it's gaining in purchasing power if you're buying it at the right time, because it goes through these overvaluations and undervaluations. And when you measure it against, decades of history, what you see is that we are still in a severely undervalued state right now. So it's gold and silver. Gold, if you use the CP lie, yes, it's corrected against inflation. Exactly. That's what causes a peak, is everybody trying to rush into it at the same time. And what we are actually seeing in the retail sector is low sales volumes right now. The public is still like yawning when it comes to gold and silver, and they're chasing the stock market right now, which is the Buffett indicator is just in insane valuations. When this next crisis happens, it's going to be one of the worst that has ever happened because there's so many things are just so skewed. But what's interesting here is you have the shadow stats CPI, also called the shadow stats alternate CPI. Now, a lot of people think, oh, well, that's just some nut putting together. No, John Williams was an insurance actuary. And in the mid 80s, all of his models stopped working. And he was wondering why. And he started researching it. And then he found that the government was changing the way that they calculate inflation. They kept on messing with the CPI. And he went back and what he uses for this alternate CPI is the government numbers from World War II to 1982, the method that the US government used to calculate inflation. So these are both sets of government numbers. One of them keeps on getting massaged periodically anytime the CPI is coming in too hot and it makes the administration look bad, it seems to get adjusted. So what have you got there? I've always said also that the truth probably lies somewhere in the middle. But these are two sets of government CPI numbers. And one of them is adjusted to sort of cheat Social Security recipients out of their full, they don't keep up with the true cost of living. And all you have to do is, if you look at the CPI and look at your personal purchasing power, where it has gone and prices, go to a restaurant. I've been traveling. You order a hamburger and a beer in a airport. Oh my God, it's just unbelievable. So,
yeah,
gold and silver have not kept up with true inflation, the inflation that you experience day to day. So I believe that the truth lies between those numbers. But gold is nowhere near being in a bubble. And so it shows that it should be, if the green government CPI was true, then gold would be in a bubble, which would mean it would be of a large percentage of global financial assets, that it would be on the news everywhere, that every financial planner would be recommending put 30% into, what's interesting, nobody recommended gold back in the 70s until the last, all the financial planners switched to recommending gold. Put 10, 20, 30, 40% into your portfolio after the peak in 1980. And there's a movie called Brewster's Millions with John Candy and Richard Pryor. And Richard Pryor is going to inherit a whole bunch of, it's like $33 million or something like that.
Gold and the US dollar typically exhibit an inverse relationship. When the dollar strengthens, gold prices often decline, and vice versa. This dynamic is primarily due to gold being priced in dollars. A stronger dollar makes gold more expensive for holders of other currencies, reducing demand and thereby lowering its price. However, recent market conditions have highlighted a more complex interplay between these two assets. As of August 14, 2025, gold prices extended their rise for a third consecutive session, bolstered by increasing expectations of a U.S. Federal Reserve interest rate cut and a weaker dollar. Spot gold edged up to $3,357.65 per ounce, while the dollar remained near multi-week lows, aiding gold's appeal. Ongoing conflicts, such as the Russia-Ukraine war, have driven investors to seek safe haven assets like gold, even when the dollar is strong. Global central banks, particularly in Asia, have been increasing their gold reserves to diversify away from dollar-denominated assets, providing steady support for gold prices despite the US dollar's strength. Persistent inflation has kept gold attractive as a hedge, even in a strong dollar environment. The dollar's decline boosts gold's purchasing power. Mike believes silver reaching $100 to $200 is inevitable. Historically, silver has experienced significant price surges during periods of high demand and limited supply. While reaching $200 per ounce would represent a substantial increase from current levels, silver has surged in 2025, reaching multi-year highs, driven by strong demand and safe haven buying amid global economic and geopolitical tensions. Major financial institutions, including HSBC, Citigroup, and Bank of America, have raised their price forecasts, citing tightening supply and robust demand. When gold hits around $5,000 an ounce, investors may shift to silver just as they did in 1979. Despite these gains, experts like Michael Oliver consider silver undervalued and see potential for significant upside. Market dynamics, including industrial demand and limited supply, support continued growth. However, investors should remain mindful of potential volatility. Now, let's memorize the interview.
Pretty nicely, sort of where it feels like it should be, which is, below halfway, but certainly not at the bottom of the valuation channel.
Right. And what's interesting here is that it's actually closer to the shadow stats line than it would have been to the CP line. And M2 is basically where all of the dollars, this is the dollars that get created by the banks and the Federal Reserve. And they go out into the economy. So this is covering true inflation. This is also covering the inflation of the stock market. If bonds are getting inflated, if real estate is getting inflated, in the CPI, they decided that you don't actually own your home, you rent from yourself. So it's a rental equivalent. It's insane is what the CPI is. But this sort of corroborates what I was saying, that the truth lies somewhere in the middle. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. We don't have lines at coin shops. We don't have it in every newspaper's headline. It's not on the news every hour. It isn't dominating, and it will. There will come a day where it dominates the news cycle. Adjusting it compared to all these other financial assets, and it's what percentage change did real estate, the stock market, the 10-year Treasury, GDP, currency in circulation, M2 currency supply, what percentage change did they have from 1980 until today? Now, the numbers are somewhat different than what you just saw in those graphs because we used the intraday high of $52.50 instead of $50. So, So this corroborates that M2 scenario of inflation. And we've got the dollar is collapsing. If you take $100,000 worth of gold and it goes to $10 million, yes, the dollar is collapsing. But you can buy 10 times more cars with your gold that is pricing those collapsing dollars. It is the canary in the coal mine. And what happens during an event like when the dollars are losing value, and they have been, I can buy so much more real estate, stocks, just about everything I can buy more of today because I've been invested in gold and silver for so long. And other than cryptos, best performing asset of this century. And when you include cryptos, best performing, Bitcoin is up again. I don't know. Maybe it's not, but as of like a week or two ago, a best performing asset of this year, including cryptos. Mm-hmm. And so, yes, it is the dollar collapsing. That's part of the skyrocketing price. And that's the reason you've got to stop measuring stuff in terms of dollars. So I think the low range of where silver should go is that CPI number. That is like if we don't end up, I think triple digits is even inevitable without monetary demand. Getting to 100, 200, that still would not, compared to those other financial assets, that 200 wouldn't be in a bubble. The CPI, the current one, the low CPI is just that. It's a lie. And so I would look at $200 as probably the floor of a predicted future price. When? That's the problem. I don't know. I know that, if you look at my first book, there I made like 10 different claims in them. 7 of them came true. The other 3 have yet to come true, but they will. It's just taking a lot longer than I thought. 2015, so the price of silver is more than double what it is, what it was then. But still, that gives you an idea. And that 1980 rush, that's what a bubble looks like. That's when silver was in a bubble. It's nowhere near that today, but that day is coming. And I do feel that it'll be somewhere around $5,000 an ounce gold, where people will look at it and go, wow, this was $250 an ounce in the year 2000. I think, maybe the silver is a better bargain. Mm-hmm. They'll think there will come a day where they think gold is too expensive. That happened in 1979. Gold had gone from $35 to $400. And people changed their preference in late 79 from gold to silver once gold was perceived as being a little bit on the expensive side.
Investor sentiment, geopolitical conflicts, and macroeconomic factors influence the complex environment in which gold and silver are navigating. Silver remains relatively inexpensive and has considerable room for growth, while gold maintains its purchasing power and continues to enjoy robust demand from institutions. Supply shortages, industrial demand, and safe haven purchasing all support both metals, indicating that prudent allocation now could yield significant returns in the years to come. Investors will continue to need to keep a close eye on market variables, such as inflation, dollar swings, and international crises. How will central bank purchases and continued geopolitical tensions affect the price of gold and silver in the upcoming year? How can the price trajectory of silver change if investor preference shifts from gold to silver? Please feel free to express your opinions in the comments section below. If you found this helpful content, please remember to subscribe to remain updated and to give it a thumbs up. Thank you for joining us on this journey.